Okay. Sound looks good. Connection looks good. Looks like we're live. Welcome everybody to Midas Investing Live. Should be a fun little show today. Double check a couple things here before we get going. Make sure everything looks good. Okay. So, I'm going to primarily be talking about really two topics today. Firstly, we're going to go into a little bit of a analysis of the current inflation data as it currently stands, and some thoughts about where it might go over the short to medium term here in the near future, especially in the context of the war that's now ongoing and the Strait of Hormuz being closed and all that jazz. So 2 weeks ago, in the last show I did an update of my business cycle analysis. So if you haven't watched that, I would definitely recommend watching that. And I'm pretty sure I mentioned at probably multiple points in that video that all of that was as of the data as of January, for quite a lot of it. But I think technically the only thing that wasn't as of January would have been the GDP data, which would have been as of the end of December. And technically you only received that data and not only after January, but like the end of February, which is why I was kind of doing that analysis at the start of March. So, I had done that, and I had said, I think in the video at one point, that I was going to plan to do other little analysis in my shows, ongoing, discussing the subparts of that cycle analysis, that being growth or inflation or employment, liquidity, credit, a variety of different different subcycles that I kind of discussed within that, productivity as well. So originally I was planning to actually go into growth first, to kind of focus on kind of like the big one, the big primary one that people focus on the most. But I figure actually, what with the ongoing conflict, it would probably be good to do inflation, for one, because it's kind of going to be somewhat topical, I think, on front of people's minds for the next 6 months, probably at least. Could easily be twice that, quadruple that, but we'll say 6 months at least, and see where it goes from there. But also because the data still hasn't really come out too much different from that. We now do have inflation data as of February, so we do have a little bit more inflation data than technically I showed 2 weeks ago. A little bit more to show in that regard, and I'm also going to be showing much more specific inflation data rather than just that kind of like normalized cycle analysis like I did last time. But the point is end of February was also right before the conflict started, so it'll kind of like set us up for like what the data looked like exactly right prior to the conflict. And then, like I said, I will kind of give some thoughts about like where I do think the data might go over the short to medium term. But at the end of the day, who knows? We'll have to see where that goes with this. And I figured it's good to kind of move that up right now. And like I said, do this with the data as it stood right before the conflict, because I do plan to do basically kind of like all of this analysis on a regular basis, including the business cycle analysis, but also the sub pieces, ongoing, every 3 to 4 months on a regular basis. It's really every quarter, but really there's enough of these data pieces that may not get through all of it in a quarter necessarily, so it might actually be more like every 3 to 4 months that I cover, say, inflation itself specifically. So basically the idea being, we're going to cover inflation again probably in 3 to 4 months, at which point it'll be a good spot to kind of see where we are after we've kind of had some of the potential effects maybe cycle through. So anyway, long introduction on that, kind of saying what we're doing with the economic analysis today. But after we get through that, then we're going to talk FG, pretty much entirely about FG. I said that last time, I think, as well, that I had been working on new models for FG, and I have been continuing to work on that, like I promised. So I plan to kind of show you what my new model looks like today. I did kind of want to go through a lot more discussion about details related to them and go through their 10K in some high detail. So I'm going to try to do that stuff as fast as possible because really I want to show you the model. And so really I'm probably going to be trying to breeze through the FG stuff as quickly as possible because there's sort of a lot I want to show, but we'll see how that goes exactly. At the end of the day, it might end up just having to be something that branches into multiple shows for that, because obviously I can talk about FG till the end of time. But the point is, I do have a new model that I've built up for FG. I've met through several iterations on it, and so now I feel pretty confident, more so than I already did before. I mean, I've always felt more and more confident about FG, but there's always been aspects of it that have been hard to create certainty around, especially like in terms of like cash flows versus earnings. It being a finance company, it's a little bit tricky to do, and with like their annuities, you have to make pretty big assumptions about what's going to happen with the markets in order to determine like their index credits on the annuities and things like that. So it's like, there's a lot of assumptions that it can be tricky to make about, and obviously with all of the private credit scare and stuff, that's definitely just made me definitely go back and forth and be like, okay, well, have I really made sure about this risk versus that risk? So anyway, we're going to get into all that later. So as I said, we're going to discuss inflation first, though, get that out of the way. And hopefully we can kind of breeze through that relatively quickly too, so that we can leave even more time for FG, since I think that might be the thing that really takes more time than really necessary. So with that, let me go over to my business cycle analysis chart here. So here was that normalized inflation metric on the standard deviation kind of basis relative to like the normal pathway it goes in during a recession, which, as I kind of had said before, it is inverted for this. So when you see the metric going down, that's actually inflation getting worse. And therefore this going up is when inflation comes down and gets better, so to speak. And here you can see it's sort of been flattish as it is. But if you look at the core data that technically underlies that, that's just the CPI itself. And so here I show the CPI with the blue line shows the CPI on a year-over-year basis. And then the red being the 6-month annualized basis, and the yellow line being the 3-month annualized basis. And I like to look at it this way because it gives you an idea of like where the momentum is currently turning with the metric. If the 3-month is higher than the 6-month, which is higher than the 12-month, then that means that you're like proper accelerating. You're starting to curve upward at an accelerating basis for inflation, which, by the way, that is the current condition. You can see right here, it is in fact in that condition right now, and it's been in that condition for basically 2 months, as you can see, since basically the start of the year. But I'll point out that you can see that you're in that condition oftentimes for a few months, and then turns back around for a few months, and then he goes back for a few months, and he goes back and forth for a few months. So you can see that the CPI tends to oscillate. There is a lot of like kind of like back and forth, ebbing and flowing within the larger pattern. So where those short-term ebb and flows are going to go versus like this kind of like larger leveling out that it has here, say at a high 2s, which is kind of what you can see the year-over-year level is kind of leveling out to. The things that drive those are different than each other at the end of the day, which I'll kind of get into more of that a little bit more here in the short term. So anyway, we're going to come back to this chart here in a second, but coming over to the Federal Reserve, here I have the different headline measures for inflation. Here, the CPI being the most commonly thought of headline measure for inflation, but also the PCE measure, which is like the Fed's preferred measure for inflation. They like the core version of this, but this is the complete version of it, including commodities. And then also I include the PPI index, which is not really a consumer inflation measure, but it is a measure that is still kind of reported pretty regularly as the kind of the wholesale inflation measure, or the producer's price, inflation measure. So this still has a big impact on profit margins, especially the difference between the PPI and the CPI at any given point gives you an indication of like the directionality of where profit margins are going. And as a result of that, PPI can be useful because it can actually be a little bit of a leading indicator of where inflation might go, being the CPI measure, in the kind of those short terms. Like this drives some of those short-term ebb and flows, because as commodities swing one way or the other, producers have to adjust their consumer-facing prices to deal with that. For the prices that are flexible enough to deal with that, that being like durable good or non-durable goods, and some durable goods in particular. So anyway, coming on along with that, Here we actually have the core measures focusing in specifically on core measures, which means that they're subtracting out food and energy costs for these first ones being the CPI and the PCE. So this is the core PCE, the Fed's preferred measure of inflation. Oh, technically, before I come over here, I did kind of want to zoom in here on the very short term. Zooming in on, say, like the last 3 years, or really we can even zoom in on the last 2 years. I kind of want to focus on that because it gets over, as I said before, it is kind of leveling out here in these high twos kind of level. And you can see that the PPI had bottomed out really like 3 to 4 years ago and has been slowly increasing ever since then. And it's overtaken the CPI and the PCE measure here in kind of like the fall of last year or so. And it was kind of even with it, dipped back below it, and it's now kind of like even with it, roughly speaking, when keeping in mind that the PPI measure tends to swing back and forth at a little bit more of a violent, higher increase or decrease rate. So it is kind of interesting that it's kind of like pinned here currently at roughly the same level as the CPI and the PCE. Again, coming back over again to those core measures, as I was saying here, core measures we have for CPI, PCE, and then I also include the market-based core PCE, which basically means that they're looking at real-time market-based commodity prices wherever basically they can, rather than just looking at like where the transactions occurred at the store or in the way that the data reports of the PCE measure. And then also it does a similar measure as the core PCE, but focus in on services and then subtracting out energy and housing. This is that super core measure that the Fed started talking about a lot more post COVID, because they were really kind of trying to focus in on like what is the inflation that was outside of the supply chain issues. So zooming in here again on the most recent 3 or 4, even 2 years or so, we'll do 2 years. It kind of gets us in right there. You can see that all 4 of them are at kind of like slightly different levels here, but really between kind of like the and they've been coming down. You can see kind of over the last 2 to 3 years or so, but only really just barely so. And I would say it's like some were coming down more so than others. So like super core has kind of come down, continue a little bit more over the course of this time frame. And I would say the core CPI has continued to come down, whereas core PCE has been a little bit more flat basically for the last 2 to 3 years. And then also the market base has also been flat for the last 2 or 3 years. And you can even argue it started to trip upward a little bit. But overall, like if you kind of like took an average of all 4 of these together at any given point in time in here, they've maybe modestly come down, but for the most part over this time frame, it's pretty flat. Like maybe somewhat of a tip down right here around inflation day, but for the most part, it's flattish ever since. And averaging kind of around 3%. 3% kind of seems to be the spot where like the core level of inflation is once you're kind of ignoring the swings in commodity prices. So having looked now both at the CPI and the core PCE, I did want to come back over here to this business cycle where I showed the 3-month, 6-month, and 12-month annualized for the CPI, because I did also want to show that for core PCE as well. So taking away the swings in commodity prices, how does the momentum in inflation look like? Because you can see there's a lot more of this back and forth swings in the normal CPI, because that includes the food and energy costs. But if you're looking at core PC, which just subtracts out the swings in the commodity prices, you can see it's a lot flatter, with the 12-month average, as we were saying, over the last like 3 or 4 years has really been very, very flat. And then even the 3-month, 6-month annualizes, they dip over it, but really not too much to say there. And in the current state definitely shows technically some pretty strong momentum. The 3-month is higher than the 6-month, which is higher than the 12-month, but only just barely. And again, as I was saying before, you can see small amounts of that for a short period of time. Really, you want to see that sustaining for several months there. So overall, inflation, again, as it currently stood, and these core measures are only as of January, it's worth noting. We have the CPI measures as of February, but the core measures do tend to be a little bit slighter, more delayed than that. So these ones are only as of January for that. So that's worth noting as well. But nonetheless, again, both of these analysis, again, pre the closing of the Strait of Hormuz. So we'll see where things go on that front. So coming back over to the Fed website, coming back to the CPI, there you can break down the CPI by different kind of categories, which can really help think about where the inflation is or is not coming from. So here I have it broken down by different sectors, and specifically durables versus non-durables versus services. And I think this is a really useful way to kind of think about it in terms of like the nature of the product being sold, not like the specific product itself, but like what is the form in which it is delivered typically. Kind of helps, because that helps you understand like what's involved in its production process. So in terms of like, people were talking all last year about inflation versus the tariffs. And I was very, very adamant all last year. I was like, look, tariffs are damaging to the economy, but they are not inflationary. Like, by definition, they're not inflationary. And I think this is a good example of basically what I meant by that. One, coming back over those core measures, as I was saying before, we haven't really seen too much upward movement, particularly in the core measures, even since 2025. You see maybe a further flattening out. And like I said, it depends on which one of these four you kind of look at a little bit there, but overall, on average, not really. And then coming back again over to the different sections by the product categories, here you can see in durables, there has definitely been upward movement in inflation since 2025, which began roughly around here. But I would also point out that technically it had already started to turn around mid 2024. So it technically wouldn't be easy to disaggregate which part of that is just the turnaround versus which part is the tariffs. But nonetheless, I would say that that is where the tariffs show up, is in durable goods, because durable goods are things that are likely to be imported. And so therefore more likely to have tariffs slapped onto them. Non-durables, there are some non-durables that have tariffs on them, and you can see maybe a slight upward movement ever since like April, May there, but a much smaller amount, because non-durables, we do get a lot of them imported, but we also do have a lot of non-durables grown here in the United States. We are an agricultural country after all. And then services is basically everything else. And I'll point out that there's been downward movement in services on a continual basis for the last 2 to 3 years. So just showing that if tariffs were inflationary, meaning that it actually causes broad-based increases across the whole economy, not just in durables, but across the whole economy, then therefore, after the inflation had picked up in the durable goods, you would eventually, maybe several months later, but eventually you would start to see a turnaround in the services. And that would show that basically the increase in prices in the durables had eventually moved on to causing increases in prices in the services. But that's just not how it works. It's like tariffs cause increases in prices at the border, which causes economic inefficiencies, which causes a decrease in aggregate demand across the economy as a whole, which therefore is deflationary. So that's the true mechanism. I know I've said this like a dozen times on my show, but again, it's like one of the biggest economic fallacies that everyone seemed to get wrong all last year. So I feel like I have to constantly talk about it. And this is the chart that kind of helps explain it. It's like if tariffs were inflationary, this kind of like deep blue violet line right here would have started to turn upward midway through last year. And we don't really see that. So that's my point. That's my point. Moving on from there. Also, I do have it split off by the different product category in terms of like the actual product being sold, not by like the sector and form in which the product is delivered, as the other one was showing here. So like food and beverages, shelter, fuel, utilities, transportation, medical care, education, communication. I like to look at this one. You know, there's not a ton to say about this one in analytical analysis, other than it tells you kind of like where the current inflation is showing up in consumer prices. And so it gives you an idea of like essentially what you can focus on as potentially the issue. And as we were kind of saying before, obviously a potential inflation spike that we might get from the Strait of Hormuz is gonna show up probably in fuel and utilities, since that is where gas prices are. But I will point out that that's actually where we're already had hotter inflation due to utilities costs going up, electricity costs going up, which is one half of it. In fact, if you would look within the subcategory here, because fuel and utilities, you can go to the BLS website and break each of these down even a lot further. Gas prices for the last year or two had been going down pretty significantly, which obviously the administration had been bragging about prior to this conflict. So, you know, easy come, easy go in that regard. So we'll see what happens on that. I expect this one to stay high, if not get hotter. The real question is what happens with the other categories in the meantime. What with fertilizer costs coming through the strait as well, it's not unreasonable to believe that food and beverages costs inflation could get a little bit of an increase as well in the short to midterm. So we'll have to see about that. Shelter has been kind of on a downward decrease for quite some time. There's no reason to believe that it won't continue to decrease over the short term, although it should start to level out at some point here, since actual oil prices have a really started to level out as well. And the transportation costs, that should also probably spike due to the strait to a certain extent. And the medical care and education, well, it depends on what happens with throughout the economy as a whole. But all else equal, if those other categories go up the way you would expect the aggregate demand to go down, and therefore medical care, education, communication to probably decrease to a certain extent. And technically there are other categories that I didn't include here, but these are kind of like the majority of where the costs are on a broader basis. So moving on from that, I also like to look at this, which is the producer price index. They have it broken off by the intermediate demand, but by different stages of production, which is kind of interesting. So when you're doing like manufacturing, obviously there can be like many chains along the production in terms of like how many products had to be bought before this next product can be made, which can then be purchased by another company to then be put into another product, right? You can sometimes have many chains along the production line before you get to a final good that a consumer actually uses, or even a business completely finally consumes. So here it breaks off by 4 different stages of demand, as well as the final demand category. And I like to look at this because I do think it can kind of give you an idea of like where producer prices themselves may or may not be accelerating, because they tend to kind of lead in line with each other. So if you kind of like zoom in here on the last few years, what we can see is that the stage 1 has been accelerating for the last few months here. The stage 2 hasn't particularly been accelerating, which is interesting. And then stage 3 is also not particularly accelerating. And then stage 4 really is accelerating. So kind of interesting. And I think I mentioned this the last few times I showed the chart, is that, yeah, it's not giving you the cleanest signal, because really what would be like a really clean signal would be like stage 1 and 2 really hot, and then stage 3 and 4 not as hot, and then the final demand kind of like just being here in its normal trend. And then what that would mean is that you would have good confidence that 6 to 12 months later, final demand would kind of be tipping upward. And if producer price final demand tips upward, then that means producer price all commodities is tipping upward, which would mean that eventually 6 to 12 months later, consumer prices would be tipping upward. So that's why it's interesting to look at. But as I say, it isn't really giving the cleanest signal, with stage 1 and stage 4 being hot, and then stage 2 kind of being in the doldrums a little bit, although it's starting to tip upward in the last 2 months. So we'll see. And then stage 3 kind of actually being on a weird downward trend. So not really a clean signal from this one, but it is one that I do like to look at from time to time. So moving on from that, those are all like the actual inflation data measures that I like to generally look at. But then here, what I have is a bunch of different measures of expected inflation, which gives us an idea of like how the market is thinking about where we are. Hold on here. I think it's not showing the last month or so. Yeah, there we go. So here we have the 5-year break-even inflation rate, which basically means what the bond market is pricing in as the inflation rate over the next 5 years, and then also a 5-year break-even inflation rate that is oh, my bad. The deep one is the 5-year break-even inflation rate. So showing what the inflation rate is expected to be over the next 5 years. And then this light blue one is the same measure, but showing how much that's changed on a year-over-year basis. Not the percent level that it's changed, but like the actual change in percentage that it's had over the last 12 months. And I like to use this because this gives us an idea of like where those expectations are changing over time. So if the line is moving upward, if it's around the 0 line and is moving upward, that means inflation expectations is rising. And if it's around the 0 line and moving downwards, that means inflation expectations is dropping. And that corresponds to the dark blue line here at the top. And then also I have a 5-year expected inflation measure, which is a Fed-based model that includes technically this break-even inflation rate, but also includes swap data and technically survey data. It's their own internal model that they've created for it, which you can see gives a somewhat similar measure. And then there's 5-year forward measures for both of those, which basically says not the next 5 years, but the 5 years after that. So if you were talking about a 10-year period, it'd be the second 5-year period within a 10-year period. And what that's usually useful for is giving you an idea of what the long run expectations are. So basically, like if the first 5 years, maybe there's like a big supply shock going on, like say a war in the Middle East, well, then maybe that one might spike upward. But if you look at the 5-year forward inflation expectation rate, the market will potentially and very, very likely be looking past that inflation shock to say, okay, well, in the long run, years 6 through 10, we don't expect inflation to be too high necessarily. And likewise, I would actually kind of point out that if you kind of like zoom in here So it can be a little bit hard to see, but you can see that the 5-year expected inflation rate on the market-based one, because that has the most recent data, that has actually started to move upward since the start of the year. Not to a super significant degree, because it was at like 2.25, and now it's at like 2.6. So it's increased by like 35 basis points, which, you know, I mean, that's something, but talk to me when it gets to like 3%, right? That would be more substantial. Which, for example, like you can see that we were at 3% back in 2022. So for that deep blue line is the one I'm talking about. So that's what I'm saying. It's like, well, we'll see when we get there. But at the same time, if you look at the red line, wait, is that the right one? Yeah, the red line, which is the 5-year forward of the same measure, you can see that, wow, the deep blue one has tipped upward since the start of the year. This one has actually moved downwards slightly since the start of the year, which is actually pretty normal. The way the relationship works between the two of them, usually the expectations don't shift exactly in line with each other. So if one goes up, the other goes down to a certain extent. And there's actually some logic to this if you understand, like, one of the more recent popularizing theories about how inflation really works and how interest rates affects inflation, which I'm a large proponent of. I know I've talked about it here on the channel before. It's something called the fiscal theory of the price level by economist John Cochrane. Basically, he talks about, like, it's his current theory explaining like why inflation appears to be related to government debt and expectations about how it's is or isn't going to be paid off, and then also at the same time tries to explain the mechanism of how and why the government discount rate, interest rate at the Fed would have an impact on inflation under those terms. And I'm pretty sure I mentioned it before, but like kind of like one of the core logics in the mechanism is that you raise interest rates in order to tamp down inflation in the short term, but the Fed can't actually destroy that inflation, because that inflation is basically the discount rate that creates the present value of future surpluses in the budget equal to the current market value of the debt. And so basically inflation is the tool that the market uses to essentially make the debt actually the size that you can afford to pay off in the long run. And so you can raise your interest rates and that tamps down the inflation today, but it doesn't do anything about the total inflation. So essentially you're transferring that inflation into the future. And you're going to eventually have to deal with that inflation later. And then likewise, if you lower interest rates today, you increase the inflation today, and then that lowers the value of the debt and therefore lowers the inflation in the future. So there's kind of like a seesaw action back and forth between long run and short run inflation and long run and short run interest rates. And so because of that, you see this mechanism right here where, like I said, inflation expectations for the first 5 years goes up at the same time as inflation expectations for year 6 through 10 goes down. But not as much. You can see that this one goes down smaller than this one goes up, because you have to deal with a higher level of inflation in the short run to essentially achieve a smaller level of effect of lower inflation in the future. You're paying for it now today via inflation is basically how it works. And like I said, that's just the mechanism. That has nothing to do with like the reason why we're having inflation maybe now, which again is oil and whatnot, which like I said, doesn't show up in pretty much any of the data we've talked about here today, because all the data here talked about is generally January or February. But this is bond prices. That is, a lot of it comes real time. So this does have March data right here. This like last little bit of the blue line tip up there, that last little bit right here is since March. So this does include at least a little bit of reaction from the bond market due to the conflict. Not a lot of it, but a little bit of it. Like I said, we'll talk about the same data here in 3 to 4 months and see how things look at that point. So moving on from that, another thing I like to look at here, a really neat relationship I like to look at is the relationship between import prices and export prices. There's an import price index and export price index that the Federal Reserve likes to report from the Bureau of Labor Statistics. And if you divide import prices by the export prices, so essentially like how much are import prices going up more than export prices are going up. And think about that. So like import prices are the inputs into the things that eventually get sold in the CPI, right? Versus export prices are not for things that are in the CPI, because the CPI is the American consumer prices. So if you export it, it's not going to show up in the CPI at all. whereas import prices, at least to the degree that those price increases get passed on by the producers, do show up in the CPI. So if you divide import prices by export prices, essentially what you get is this very, very neat relationship with the CPI on a year-over-year basis. I will point out here that this metric is on different axes though, so it isn't a super tightly knit relationship. Whereas, like for example, the CPI you can see is about sitting here at the like 2.5% line, whereas like the export price here, that same spot is about 0%. So you can see is like it's fitted, but there is essentially a what's it called, a constant in the linear equation that you would have there, a constant of about 2.5%. But the point is, it explains the co-movements though. That's basically what I'm saying. It's like it doesn't explain the level of inflation because the inflation itself comes from somewhere else, but this does heavily explain the movements of the CPI on any given 3 month, 6 month, year, 2 year kind of basis, so to speak. And then one thing I also like to point out about this is that there is obviously one big period here where there's a huge outlier, and that's obviously COVID, where you can see that there's a huge divergence between the two, where the CPI jumps upward during our inflation spike post-COVID, whereas the import price divided by export price does not do that much at all. And they eventually here in kind of mid 2023, they link back up together. And that to me explains how the inflation that we had after COVID had more to do with the increase in the money supply than it had to do with the changes in the supply and demand dynamics from trade post-COVID. Because if that was the case, then it would be explainable by the import prices versus the export prices, which it's not. There is obviously going to be a period there where that has something to do with it. There was an impact there, but it's not as big, I think, as a lot of people point out to be. In fact, I would say that you can almost see that like here in 2022 to 2023, which is when the Ukraine conflict started, you see a much larger disruption to the import versus export price dynamic during that time frame than you do immediately post-COVID, which frankly makes more sense to me because, by the way, the Ukraine conflict was disrupting a very similar level and set of commodities as the current conflict is. Not quite as high of a level of oil overall trade demand impact is from the Ukraine conflict as is in this current conflict in the Hormuz Strait, but a much higher level of fertilizer as well as wheat production had been disrupted as well. So it's one of those things where I will point out that while we should be concerned about inflation dynamics following this conflict here, we did already have somewhat of a similar disruption with a similar conflict. And we just already had inflation at that time frame. So I think the level of impact that the Ukraine conflict had on the inflation was somewhat hidden because we were already coming off of high inflation. So what it probably did was it probably helped slow down the impact of the inflation coming down. Like the Fed having to raise interest rates. Like the Fed was probably forced to keep interest rates higher for longer than they would have otherwise because of the Ukraine conflict, is basically what I would say there. But you don't see the spike up because we were already at an even higher level. So that's where I think it's a little bit different there. But yeah, I mean, if we do zoom in here though on the last few years here, you can see it has come together a lot more closer, and they don't necessarily, like I said, move together perfectly on a month-to-month basis, but over 6 months, 12 months, they tend to be pretty neatly linked to a certain extent. So here it'll be interesting to see what happens over the next few months on that regard. And as I mentioned, kind of going into this, they are on different axes, which means that there is a pretty significant intercept to the equation there. It's just the co-movements themselves is a pretty big deal, but that also kind of relates to many other measures. So this other chart here, not going to show too much of the analysis of it, but this is something that I put together when we were having the government shutdowns. Because we were going through the government shutdowns, that meant a lot of these data sources that I like to use were disrupted, and that meant I couldn't get the data that I normally like to look at to get an idea of like where the economy was. And then at the same time, that made a lot of people start to call into question the quality of a lot of the data as well, because either A, we weren't getting the data because the surveys weren't being answered, or B, people were concerned about political lackeys being put into place for the data collections. So I was said, okay, well, something that you can do is you can look at private data sources versus public data sources, right? So like oil prices, copper prices, interest rates, the S&P home price index. All those things come from non-governmental sources. Those are data points that come from public facing privately owned institutions rather than a governmental institution. And so these were some of the best metrics that I found for trying to correlate literally to just month by month CPI. Like if you really wanted to try to predict what the next CPI print was going to be, I found the oil prices, copper prices, the 2-year interest rate, as well as the S&P home price index changes to be like the most effective tools for that. And so, like I said, I was using that when we had the government shutdown. The government isn't currently shut down for the BLS currently. I mean, no, technically DHS is still shut down. But the point is that oil being one of those key ones is obviously now a big point of contention here for that. And oil, by the way, is probably the most effective out of all these, other than maybe the interest rate. And the interest rate, I think, is a little bit different than the other ones, because the interest rate is actually, it's sort of like a backwards relationship, whereas like the interest rate is price based off of where people expect inflation to be. And so it predicts inflation relatively well, but only because markets themselves are trying to predict inflation. Whereas oil, copper, and home prices literally go into inflation. Like those are literally components that go into the price. The 2-year inflation rate does not go into the consumer price. So that's like kind of a little bit of a difference between those metrics to a certain extent. And also I'll point out that all of those metrics, except for the interest rate, also are on different axes. So it just goes to show that like the level of extremity of movement is pretty extreme for those two, but nonetheless, those were some of the best code movements. So anyway, come over here, looking in specifically at oil prices and energy prices and inflation. Here we have the consumer inflation on a year-over-year basis. We have gasoline prices, average gasoline unleaded price in US city average on a year-over-year basis, and also WTI, which is basically like US priced oil on a year-over-year basis. And so basically, obviously, the natural logic is that if you get a spike in oil prices, you're then going to get a spike in gas prices, and then eventually you're going to get a spike in consumer inflation prices. And I'll point out again on different axes, because the movements are pretty extreme. Like here you can see the oil prices at their highest point were spiking up more than 200% on a year-over-year basis, whereas since the late 80s, the year-over-year inflation, the highest level it was at was about 9%, where we topped out in 2022. So you can see very, very big difference there. But you can see how the relationship does work though. You can see spike in oil, a little bit on a slight delay, but very, very closely followed. You get spikes in gasoline, even if it is at a slightly different scale there. And then a few months later, but now a much larger delay, like the delay between oil and gasoline is like 1 to 2 months, right? There's like 1 to 2 months between the relative spikes. And then if you look between gasoline and consumer prices, the lag is a little bit longer and a little bit more variable. It's like 1 to 6 months, right? And so if you kind of like add those two ranges together, 1 to 2 months to 1 to 6 months, that gets you like 2 to 8 months, right? Would kind of be like the combined range, and essentially in like how long it takes for oil price spikes to filter through and affect consumer prices. 2 to 8 months, midpoint there being 5 months, you could say. So I don't have the spreadsheet in front of me, because technically I did it on a different computer, but I did yesterday kind of do a relatively simple regression analysis, and I didn't like super fine tune it to a month over month basis. So technically there is some like year over year basing bias within the regression, but nonetheless, I just kind of wanted to have like a simple answer of basically saying like, okay, well, what is the usual interquartile range of year over year movements in oil over this period since the late 80s, which I found that like basically anything over 30% is above the 75th percentile, roughly speaking. So anything over 30%. And so I basically said, okay, well, whenever you have spikes over 30% in oil, what is the movement that you get in gasoline roughly 6 months later, my bad. I just did 3 months for each one, 3 months and 3 months. I said, what is the spike in gasoline you get 3 months later? And because you're using the simple regression with a year-over-year basis, it's gonna kind of forgive the fact that we're not certain about what the lag period is. So then after you get a spike in gasoline, what is the spike in consumer prices roughly 3 months later? And so you can kind of like run through it and basically see, okay, well, what is the usual typical change in the consumer prices you're going to get once you get a above 75th percentile jump in year-over-year basis of oil. And so what I ended up getting is that it's roughly 11 basis points in CPI per month that you get on a cumulative basis to 1.32% per year. So basically, if that regression basically says that like if oil spikes more than 30% on a year-over-year basis, then what you could assume is that if that was to continue for a full year and you were to stay above that year-over-year level for a full year, then by a year later you would have CPI roughly 1.3% higher. And like I said, it's on a cumulative basis, and there is like a compounding effect to it. So it's not like it's 11 basis points 1 month, 22 basis points the second month, 33 basis points the third month. It doesn't like linearly scale. It actually kind of like parabolas into it technically. So really, you're probably not going to feel much effect at all for the first 3 months at least, and then maybe even close to 6 months. It still doesn't feel like hardly any effect. But then months 6 through 9, it's really going to start to scale up, and then really you're probably going to feel like half of that 1.3% is probably going to hit literally at the last 3 months, the last 3 to 6 months of the year. But basically, like I said, long way to say though that yeah, if the strait stays closed and like literally stays closed through the remainder of this year, then it's not unreasonable to think that a year from now inflation would be 1.3% higher, which it's currently hanging out at like 2 and change, 2.4 or whatever, I don't know, something like this. And technically I think we're hanging out at like a little bit behind, so whatever. The point is it could definitely be mid threes, if not low fours. Low fours on probably the higher end of things, mid threes on kind of like a more typical basis of things. Yeah, so that's what I would say. And also, like I said, CPI currently is hanging out on kind of like the mid to low twos right now. But my kind of like base level of where CPI is like 2.5 to 2.75 or so. Like that's kind of where I think the base level of inflation is on a kind of a secular basis. Because again, this gets back to what I was talking about these kind of like co-movements is like when you see that I have to put it on a different axis and you don't have it on the same axis, what that tells you is that it explains the co-movements well, but it doesn't explain the actual level of inflation, right? Like these oil spikes explain changes in inflation, but it doesn't explain like why the base level of inflation is 2% or 3% or 4% or 1%, right? It doesn't say anything about that. It just tells you why it moves up and down over a 6 month, 12 month, 18-month basis. And it's the same thing with like those other private measures I was talking about, but it's also the same thing with the import export prices as I was talking about. And so like the thing is like, where does the base level of inflation come from? Well, really that has to do with the money supply and productivity. And as Milton Friedman like used to always say, is that inflation is everywhere and always a monetary phenomenon insofar as increases in the money supply are not backed up by increases in the labor productivity. That I'm kind of slightly paraphrasing that to a certain extent there, but that's basically explains what inflation is that increases in money supply that aren't backed up by increases in productivity cause increases in inflation. And you can see that here on a yearly basis. I'm showing the increase in the M2 money supply divided by non-farm business labor productivity, and you can see over the long run it tracks the level of inflation. But you can see in the short run it doesn't explain the co-movements though. You can see like the co-movements actually often go the opposite direction, like the very, very short term over 1 quarter, 2 quarter, 3 quarter, over 1 year, 2 year even. They're often actually zigzagging in the opposite directions. But you can see like this kind of like level that they're at though, they tend to go together. That's kind of like the long run. In the long run, where does inflation come from? And it comes from this. It comes from increases in the money supply that aren't backed up by increases in productivity. which, I mean, that's a whole separate conversation then to say like, okay, well, where's the base level of inflation going then? You have to say where money supply is going and where productivity is going, which is literally two separate shows I plan to do. So we'll do a separate show on liquidity, which the money supply is related to liquidity. So we'll talk about that. And then I'll literally have a separate show entirely about productivity as well, which is kind of like the secret sauce of where growth comes from. But it is very hard to explain where productivity comes from, because like at the end of the day, productivity kind of is just the word we use to explain like all of the little inventions that people make essentially, or all the new ideas that people come up with, and of all sorts, like in any way somebody comes up with a way that they can somehow do more work with less time, basically that's productivity. And there's like a million ways it shows up, and it's basically damn near impossible to really predict. There's like really only like a few factors that kind of explains that to a certain extent. But anyway, like I said, that's kind of like the long run. In the long run, like what explains the base level of inflation? Like why is it that we can't get down to 2% inflation like the Fed wants? That has to do with this kind of thing. Whereas where inflation is going over the next 3 to 12 months has more to do with this kind of thing: oil prices and interest rates and copper prices and other commodity based stuff, imports, exports, prices, and things like that. So it's kind of like two different factors there. So anyway, that's kind of my analysis around inflation. Long way to say, like I said, if you were kind of looking at the base level of all of it prior to this conflict, I would have said that the fact that the core measures are so stable where they currently are makes me think that inflation is pretty stable generally overall. But like I said, I do know that the kind of long run kind of level of inflation is pretty stuck around 3%, which is kind of where the average of those core measures are. They are kind of averaging around 3%, which is a bit higher than where those headline measures currently are, more in like the mid twos kind of area. But I also pointed out that the producer price index had actually been increasing from negative levels since kind of like 2023, and it has overtaken that. So technically that's kind of like a bullish sign towards the CPI increasing too. Bullish meaning going up, not good, per se. So the point is like, well, like I said, I found inflation stable, but still likely to probably increase on a marginal basis over the next 3 to 12 months, from like 2.5 level up towards probably that like long run level that I think we're somewhat stuck at, which is around 2.5 to 3%. So probably around 3% or so. And that was kind of what I would have said prior to the conflict, like I said. And then now with the conflict, we have indeed had a spike of gasoline above that 75th percentile. So we have triggered that point where my model for that pricing has hit. And so now, according to that, like I said, it's like if it sustains that, over the next 6 to 12 months, then yeah, I would expect to see CPI prices increase at least 1%, if not 1.5 kind of percent. And like I said, it's contingent on how long that environment stays on. Because like in this period here where that regression is based off of since like the late 80s, we didn't have a similar kind of dynamic here, where there were conflicts in the Middle East, and oil spike prices in here due to conflicts in the Middle East. So like there were some similarities in the dynamics in this data set here, but it's not exactly the same. So it's like one of those things where it's like it's hard to say exactly. So but point being, yeah, so we were stable to drifting upward in CPI prior to this, and now we're probably for sure going to have CPI go up over the next 6 to 12 months. But it depends. It depends. If the straits get opened within the next month or two, well, then you would probably only see a modest increase in CPI that would be very temporary. And also, it's worth noting that technically, even if the straits stayed open for like the rest of the year, and you got that full like 1.3, 1.4% spike in inflation that my model kind of suggested, all of that is still short run stuff. That's not this kind of long run factor stuff. It's still short run. It's just short run might be in that case 2 to 3 years rather than 6 months, which kind of like I said gets back to as I was saying before, we did see similar spikes after the invasion of Ukraine, which then we did have like a slow meandering downward in oil prices over the next few years. So kind of similar potential dynamic there. So that's it on inflation. inflation talked a lot there. Potentially longer than I really wanted to on inflation, but good to kind of explain stuff like that. I know a lot of people are interested in having an idea of like where oil prices are going, and therefore where gasoline prices are going. Matters for a lot of people's pocketbooks. So with that, we will come over and talk about FG. Kind of trying to decide, because like I said, a lot to talk about FG, and I really wanted to talk about it all today, but maybe I'll kind of like try to split it in two and just do more FG next show as well, but then try to figure out like where I'll split off per se. Think about that a little bit. Let's just go let's just go over here. Okay, so last year when I did my really long stream where I was talking about FG, I know I showed this spreadsheet here, which is very, very, very large, include a lot of data related to the industry, related to the company. It was kind of a whole mess, not very well organized, but basically I built my model out of it. And essentially what I did is I kind of like took a lot of the same information, updated it with the new year, got the 2025 information for it, but then reorganized it into kind of like a much more organized fashion that splits information off by industry, but then also like idiosyncratic company information, and then a separate sheet where I put their financials, which really helped organize all of it all together for me. So that's kind of what I'm going to show you here. And it's still, a lot to look at. So it's still not necessarily super easy to explain to people that are just kind of watching through a screen necessarily. But hopefully it's a little bit cleaner in that regard. So I literally have like their full balance sheets here going back to 2021. Here at the top, their portfolio broken off into different asset types, their other assets, their liabilities all here, the different categories, their equity, income statements, the full income statements, all the different line items in the income statements, cash flow statements, all the different line items here. So all three of their financial statements completely in here, and then getting into some of their like more specific non-GAAP stuff that they have, like their gross sales, all broken up for each year. But then what I also included was I have like in their 10K, they have a lot of their the different stuff broken up, right? Like, so if you come up to their income statement, they show in their income statement, like in the revenues, the different types of revenues that they include, has obviously they have like their interest in investment income here, which makes a big chunk of it. But then they also have life insurance premiums and other fees, recognized gains and losses, and then own distribution revenues, which those ones are pretty much self-explanatory. But like recognized gains and losses technically includes a bunch of different stuff. So it's like what all is in there. And life insurance premiums and other fees, you might be like, okay, well, what does all that mean? And technically, like in their 10K, they explain all these different things in pretty fine detail. In fact, like let me come over to their 10K. And most companies do this. This is just how financial statements tend to work. Okay, yeah, here. So here, like their results of operations flowing down here, and then they show their gross and net sales in non-GAAP form right here. And they say revenues, life insurance premiums, and others, and they split off into different subsections, and they explain details about like what they are, and then also like details about like specific things that happened in this year that's special about this year versus others, and also like tells you like where you can find more information in the 10K related to these things. So it's like if you're trying to get like more and more specific information about like how everything in their financials work, this is how you kind of go through it. So like, yeah, like I said, life insurance premium and other, they get fine detail here, but then also their interest in investment income, they also explain in pretty fine detail where that comes from too. So like on their balance sheet, they have it split off into fixed maturity securities, equity securities, preferred securities, mortgage loans, cash, limited partnerships, and other. They have it listed off that way in the balance sheet, but they also in here in the breakdown for the interest investment income tell you how much of it came from which of everything. So you can literally go through and see like what the yield on each of those individually is if you really wanted to. It also included that they show the investment expense. And so what's shown in the revenue on their income statement is just this number right here, this final number right here. But knowing like what all goes into that is oftentimes very useful information. and stuff like that. And then also that they explain like how they get to the, like how they calculate the yield on average AUM, because they do have like a very specific way in which that they're calculating it. I mean, you can calculate it in slightly different ways, but it is what it is. And as I said, own distribution revenues is kind of just is what it is. There's not a whole lot of breakdown for that specifically, but even the recognized gains and losses has a breakdown to it. You might think of like, oh, that's just what they bought and sold and like the gains losses on it. It's like, no. I mean, that's some of what it is, but there's lots of things in there. So like here, first part is net realized and unrealized gains on fixed available for sale maturity securities and equity securities. So that's what that is. But then there's also change in allowance for expected credit losses. So like this is literally how they account for what they expect to lose on any specific individual investment here. And a change in allowance for expected credit losses. Now, this isn't their actual credit losses, mind you. This is just them putting money aside, them taking a loss up front to say, okay, we think that based off of the risk profile, blah, 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 we think that we might potentially lose up to this amount on all of our investments. And so this is how it flows through in their income statement, them setting money aside. So here you can see it's about 50 million and change or so for 2025. It was 30 million change for 24, 23. So that's them setting money aside for losses. And the reason why I'm going into this fine detail is obviously because people are very worried about potential for losses. And it's worth noting this because, again, like I said, this isn't them actually taking a loss. This is them upfront recognizing risks and saying, okay, well, we think we might lose a loss, so we're going to take this. And so the question is, how much actual losses do they take? This is like 50, 60 basis points against a $69 billion portfolio is what they currently have right now. So, I mean, technically you would want to do it against the average of what they had last year. Let me come back over here. Make sure I do this sort of right, I guess. So investments average from last year and this year was 65 billion or so. So we'll round up and say 60 million. It was 56 million for them, but 60 million off of 65 billion in assets is 0.09. So that's 9 basis points. 9 basis points of losses is what they set aside for what they're expecting to take. And I'm pretty sure that the actual losses, the actual credit losses they took is more like 1/10 of that. So more like 1 basis point in terms of like what it was an actual loss. And understand, like, when we say loss, what it means is like, say, okay, they loaned money to a company, or, you know, Blackstone did technically, but for their portfolio, there was money lent to a company that they have the security for. And so eventually that company stopped paying them money. And then eventually, after they stopped paying them money long enough, that went into default. And then eventually they tried to claim the assets of whatever was pledged for that debt. And then at the end of the day, they tried to pay back all of the debtors using whatever assets they were able to get back from them. And then 1 basis point of loss was essentially what FG took after they received the proceeds from the assets being sold, right? So it's not just like when I say only 1 basis point of loss of real losses were taken, that's net real losses after basically all recoveries and things like that. And like, I'm using a very general example for like how loans work. It's not necessarily specifically how FG's loans work, but that's like the simplest way to sort of explain that there. And so here, this 56 million that they're setting aside is actually probably like 10 times more than is necessary for that. Or I should say 10 times more than has historically been necessary since we have information for them for, which is since 2021. So that's kind of how that currently stands. And it's worth noting, it's supposed to be extraordinarily low losses right now because we're in a good credit environment and they haven't gone into recession. The point is that on average, between good parts of the good times and bad times, it's the average losses taken is supposed to be a commiserate amount that the yield you're getting, the rate of return you're getting on the debt is enough to pay for that risk. And so this gets back around to like that whole private credit discussion, and people are all very concerned about private credit, and historically for like years people were saying, oh well, the returns are too good in private credit. And it's like, yes, the returns are good because they're supposed to eventually pay for losses, and the losses just were much lower than people were expected, even in the good times. But eventually you come around to bad times, and then eventually losses actually do happen, which comes around to, like, again, the private credit discussion. I know I talked about it last time. The actual allocation in their portfolio, they have about 20% in private credit, which is pretty typical and was sort of what I expected of them. But then that gets to then in the market right now, a lot of the fears comes down to like everyone's judging all of private credits the same. It appears to be that like about 25% of private credit across the whole industry has been like loaned to software as a service type companies, and so that's where people are very concerned about it. But FG's management themselves said that only about 5% of their portfolio is software, which means, and they at the same time said 20% of their portfolio is origination. And I think it's pretty safe to assume that the vast majority of that 5% is inside that 20%, right? So like really they have 20% private credit, and about a quarter of their private credit is software as a service, and that's reflective of basically what the private credit industry generally has done. But nonetheless, their overall allocation to private credit is still relatively safe enough that it makes that software as a service allocation probably okay. And also, there's like I think a larger misunderstanding that like, yes, there's maybe concerns about some of those software companies, but there's a distribution within there, right? Like you can have 10-20% of those companies be in very bad shape, and that caused the type of disruptions we're seeing in like the private credit funds and the BDC funds, whereas you can still have like a much larger percentage of the private credit, even to software, be generally in much higher quality with much better cash flow coverage ratios on the debt, much better leverage ratios on the debt, generally speaking. And from all indications, based off of the information that FG has provided, that seems to be the case. Like they seem to have very high credit quality assets across the board. There are ways that you can kind of somewhat hide the credit quality of your assets to a certain extent using certain types of special purpose vehicles, and like I know people have talked about those to a certain extent, and like technically FG does have some allocation to some of those special purpose vehicles. I've investigated that to a certain extent. Like if I was to do here and say Wave, let me just say Wave, see if I can find it that way. Yeah. Here, concentrations, Blackstone Wave Asset Holdco. They have $655 million in this thing called the Blackstone Wave Asset Holdco, which is a special purpose vehicle, which is basically designed to hold other partnerships and other investments in other things. And that itself, it can be used as a way to essentially like improve the credit quality of this 655 million. So it's possible that like this 655 million is being rated at a higher credit quality than it otherwise could be. And that like could give you big cause for concerns, I would say, to a certain extent. But I have actually investigated this significantly further, and what I've like discovered is that here Strategic Partners Fund Solutions Advisors LP owns the Blackstone Wave Issuer LLC, which owns that specific holdco. Here you can see the fund assets under management at different points in time is currently about like 1.2 1.3 billion, whereas like I said, they have 655 million, so that means FG basically is like 1/3 of the fund ownership within this specific fund right here. But the thing I specifically want to point out about this is that this is a private equity fund. This isn't a private credit fund. This is private equity. And part of the issue with those special purpose vehicles with the private credit funds is because private credit that has to rely on those credit ratings in order to get their debts labeled as a good rating, and therefore to have lower capital requirements. But for private equity, well, yes, they could still use a special purpose vehicle to get better ratings. Those ratings aren't going to be related to the income quality prospects for the portfolio as a whole, like would be a concern for FG in particular. It just means that that they're keeping those assets in a special purpose vehicle probably for tax liability reasons related to the private equity. And then also coming back around to private equity itself as a discussion, or what are we down here? FG in their portfolio, they do have a slice of private equity that is like 5 percent of their portfolio or so. And so really that's fine, but that's like the more illiquid part of their portfolio where they're not deriving a huge portion of their investment income from. In fact, if I was to go back up to that investment income table that we were looking at before, you would see that it's a very, very, very tiny fraction of the investment income comes from the private equity securities. But here, limited partnerships, private equity, 3% of the portfolio, about 2.1 billion as of 2025. And so we were seeing that 655 million is in that asset holdco. So basically that means that that's like a third of their private equity is in that one partnership, which isn't then a third of like I said, the holder, which is one of Blackstone's private equity funds in here. Long way to say that I'm not super worried about it. I'm not super worried about that particular concern. That's one of the things people have brought up as concern, is that basically like the ratings that you're seeing may not be as good as they seem because of them using these types of structures. But as I've investigated FG in particular, I'm really not seeing the structure being used in the way that people are suggesting online. That's basically what I'm kind of trying to point out here. Long way to say. So also the one thing within that also, because as I was doing this, that kind of got me going further with this. So there is the $69 billion portfolio, which let me see, Blackstone, the relationship they have with Blackstone ISGI Advisors is the group that basically manages a huge portion of their portfolio, 78% of their portfolio, about 60 of the $69 billion portfolio. So let me just do some quick math there. 69 billion times 0.78. That means it's about $54 billion worth that Blackstone manages for the portfolio. And that's specifically managed by, like I said, Blackstone ISGI Advisors LLC. And so within that, when I was looking at these funds, I was like, okay, well, let me go actually kind of look into that specifically. Oh, dang, did I close that one? Let me see how quickly I can find. Hold on a second. Shit. ISGI. Cool. Found it relatively quickly. One moment. So I know this is something I had talked about before in regards to Blackstone when like a year ago. I was saying, is like, it's not only the FG is reliant on Blackstone, but I think that there's like a good cause you can be made for Blackstone being somewhat reliant on FG as well, which I think it makes in some ways enhances that relationship. And so this, I think, is another way to kind of like think about that within their structure, basically like how reliant they sort of are on them, and also like how safe I would say FG probably is within that structure for them as well. So a lot of the big funds that have been having issues, the B Cred fund, the Blackstone credit fund, a lot of the issue in regards to that comes down to them having the partial liquidity functions, where there's you can 5% of the investors can gate out of the fund within a certain time frame over certain periods of that, and that's one of the things that's been causing the big declines in those funds. So essentially, like, part of the issue is that and they're like, okay, cool, we've got these great funds that are somewhat illiquid, and that's where we're going to generate good returns by locking up the assets for longer periods of time to get longer returns. But that means we need the liabilities and the equity to be locked up for longer periods of time, and so that means it's illiquid, and that means people are now discovering that illiquid means illiquid. And so if you try to get out at a fast pace, then you often have to take big haircuts on that. But I think that the way that FG is specifically structured within Blackstone protects them from these issues to a certain extent, because the reason why that's a problem is that, like, if people leave the fund, the people who are still in the fund might be stuck with some of the worst assets, because the people leaving the fund were essentially forced to sell what they could sell, not what they wanted to sell. And if you sell what you could sell, it's often the most liquid and therefore the best quality assets, and therefore you're kind of stuck holding a pie with lesser quality assets over time. But the specific fund that Blackstone is in, this ISGI Advisors, is looks like because of the way they've structured it, it's primarily for insurance companies, specifically for insurance companies. So like here, ISGI Advisors, they currently have $155.7 billion in assets under management. You can see the assets under management over time. I'll point out that FG started their relationship with them kind of back here or so. And you can see like this has been a huge growth of the relationship within them. And so like back here, it looks like they were the majority of the relationship back in like 2020, 2021. And now they're not the majority of the relationship, it seems like, anymore, but still a pretty hefty portion. So like, as we were just saying, about $53.8 billion here. I'm going to divide this by 1,000, just put it into billions to make it easier for me. And then divide this into 155.7 billion, which is the assets under management. So you can see that essentially FG makes up about 35% of the assets under management for this advisor fund group, which just goes to show like how important of a relationship it is for this specific advisor group. And then within that advisor group, 155.7 billion divided by, let's go over to this. Find assets under management here. Sorry, should have this flipped open already. This is Blackstone's presentation deck. So here, ending balance, assets under management, credit insurance, $443 billion right there. So $443 billion. So ISGI Advisors is also about 35% of the total credit and insurance assets under management for Blackstone as a whole. And then credit and insurance assets under management as a relative to their total assets under management is also about 35%. It's kind of a weirdly coincident that they're all like 34, 35%. Like, I don't know, that's just kind of like a weird mathematical coincidence. But the point is that the relationship is strong. The relationship is very, very strong. FG is 1/3 of ISGI Advisors. ISGI Advisors is 1/3 of Blackstone Credit and Insurance, and Blackstone Credit Insurance is 1/3 of Blackstone as a whole. So it's like, it's definitely not something that they basically just can ignore. That means FG is literally like 3.5% of Blackstone's entire assets under management. That's a pretty substantial partner at the end of the day, especially considering it's just a $3.5 billion market cap company, right? Like it's a pretty big partner for is $185 billion market cap company that Blackstone themselves is, or something like that. And then also here, focusing in on this assets under management thing here, we do have the credit insurance for the last 12 months here. You can see inflows, we're getting $132 billion, outflows about $20 billion, so net inflows of $112 billion, realizations of about 62 billions. So realizations is them actually, like, you know, money going through that technically you want to see strong realizations, even though it is a negative flow. Like having the realizations drop off is a sign of their business dropping off, even though it is technically a negative to the assets under management. It's the realizations within those assets, and the market activity is actual increases to the assets themselves. So adding it all together, 443, like I said, or so $billion compared to 376 billion on the year prior. So very, very strong growth over the course of the full year. And in those last 3 months of ending December 31st, 2025, you can see strong inflows, net inflows, decent realizations overall on a gross basis, market activity positive at least, and then overall growth changed 2% within the quarter there. So this is a very, very healthy part of their business. You can see real estate's less healthy, private equity more healthy, multi-asset investing, which is kind of like hedge funds and stuff to a certain extent, somewhat similarly healthy. So credit insurance a little bit weaker relative to the total pie in the last 3 months, you could say, overall, but definitely not the weakest part of the pie in a kind of a general sense. And then in the last 12 months, yeah, 18%, very, very strong actually relative to even the whole pie there. And then the fee earning assets under management is kind of like a subset within that. I would like to point out, do they also have they show what portion of the earnings comes from each of those? I like looking at that as well. maybe not, but okay. Point being though is that yeah, they are somewhat reliant on FG. I think you can make the case essentially that it's an important relationship for them too. It's not just that like, oh, FG is just Blackstone's whipping dog and they're kind of being stuck with whatever low quality assets that Blackstone just wanted to like shove into their book or nothing like that. I think it's very much the opposite. I think FG is a very, very high quality client for them, where they put high quality assets and very much like things like BCred and the BXSL, BDC, ETF is a much more like place where you put lower quality assets. Like coming down here, as I was saying before about it, the assets actually being in high quality lockup rather than being the more liquid form. Here it shows like the breakdown of the asset under management by like the different accounts, and here you can see insurance companies. It's $155.7 billion is the total assets under management, and 155 billion of it, so basically virtually all of it, is insurance companies. All insurance companies. And it says here 32 different insurance companies. So you can kind of do the math on that. I know I did it previously. Let me just kind of like quickly do it right there. But 155 billion, it was like 54 billion was the amount of assets under management that they have with FG. So that means like 101 billion would be left over for there, and divide that by 31, which is 32 divided by 1. So essentially like for the other insurance companies, it's about $3.3 billion that they have in assets under management for each one on average. Now, like I said, on average, it's possible that really it's like 2 or 3 other companies that make up the majority of it, like FG, and then just a whole bunch of really, really tiny ones. I don't know what the distribution's like. I'm just like, on average, that's what the size is. So you can see like FG's even the big lion, even within the insurance company split, essentially right there, which, like I said, makes up the whole of it. And then, like I said, the fact that it's in insurance companies is a good thing. Like it's not a bunch of individuals, high net worth individuals. It's not a bunch of investment companies. It's not BDCs. It's not pool investments. It's insurance companies, which is long term capital. That's situated and is well timed assets versus the liabilities, which is basically means it's in good hands, generally speaking. So long way to say that, yeah, like when I was like I said, some of the concerns people were talking about in relation to like how private credit vehicles were specifically going to screw over the insurance companies that had been pinned up against them. I looked into like as many of the details that people were talking about related to these things, and at the end of the day, every time I came to the conclusion that it didn't look like FG at least was particularly at risk and particularly handling things in a way that's poor relative to these other companies in that kind of like similar form. So while kind of like talking about that, I did kind of like want to talk about some of those public vehicles related to private credit and stuff. So there is there's the high yield bonds. There's high yield bonds, and then there's the private credit funds that are basically like a high yield bond but through private credit. And I went and looked at kind of like the relative yields between the two. So like there's the high yield bond spread, which is in the red line here, and you can see the private credit yield you can see right here. And in general, they were going at a spread here. There was a period here in 2022 and 2023, probably having to do with like interest rate adjustments. I had to bet, if I had to bet, where they were trading at somewhat of par to each other on kind of a general basis. But overall, there has been a little bit of a spread between the two. And you can see currently speaking, like, yeah, that's really, really spiking up to high levels with the spread between the two higher than it was even during COVID. Obviously, the data only starts just pre-COVID, so there's not like a huge amount of data here per se. But in general, on average, about 9 to 10% yields with a spread over other high yield products of about 3% or so. And so then like within that, if I was to go look at high yield spread, high yield index effective yield, currently 7.17%. So that means that you would expect the private to be at about 10% or so. And then if I was to come back over to that, and it's currently at like 16%. So basically, relative to the normal spread that they would have compared to other high yield bonds, they currently have like almost a 50% higher yield than you expect on that, which implies massive loss expectations, massive loss expectations. So you can just looking at that, it's very, very interesting. And kind of like within that, I kind of want to actually show on a chart with this. So pull up FG, I know I've showed this like in various ways before, but I kind of wanted to show it even more, just like how stark this really is, because it's like it's easy to be like, oh yeah, a little correlation there, but like really, it really has become entirely about private credit and the quality of these assets. Like basically the entire thing. Like I know I've showed BXSL, this little fund here before. BPC, this is a private credit fund strategy. We'll put BX itself up. We'll put Apollo itself up. And then I'll also do kind of a weighted average of other ones. On here. And Owl. Okay, whole bunch of things really, but yeah, and obviously there's a lot going on in it, so it's kind of hard to see to a certain extent. But obviously the candle one is FG, and FG taking off kind of like was doing its own thing prior to that because it was a new stock, and so it was kind of appreciating of its own accord to a certain extent. And then basically, I would say since the start of 2025, these ones have really kind of coalesced around each other. Let me turn it to a weekly because it might make it a little bit easier to see. So it really did coalesce around each other. They really are closely related. But then if you zoom in even further towards like last September, where right around here, so which is when the private credit kind of discussion really took hold, you can see just how like super closely correlated they've become. Like all these are on different axes, which means that they don't have to be correlated next to each other in the same vein per se. I could actually index them all against each other and it would still be pretty close within that. In fact, maybe I will, but yeah, just look at this. They're all trading basically the same, give or take. And like I'm showing different things here. Like I said, like BXSL is a basically a bond fund, but it's Blackstone secured senior lending, which basically means it's secured, so backed by assets, and senior meaning it's first tranche, and it's Blackstone. Which means that basically all those three things together means that the assets they have are very similar to the assets that FG has. I know I've talked about that before. VPC is kind of like a broader private credit strategy ETF. So technically, like it would include BXSL, but it would include other products similar to BXSL as well, and other BDCs is included in there. And then BX is Blackstone itself. So it includes obviously assets similar to FG, but obviously it has like its own private equity business, so it's kind of doing its own thing. But it is the related entity to FG itself. And then Apollo, I have on a separate one as well, because like that one does private credit and does private equity, but also they do annuities specifically too. So they're like a direct competitor to FG in that sense as well, because they have Athene. So they're kind of like a direct one in that regard as well. And then I did like the weighted average of KKR, Ares, and Owl, because, and the reason why I did that is because these ones do private credit, but these ones don't have that kind of other relationship that makes them closely related to FG like Blackstone does, because they literally have a relationship. And then Apollo does because they have Athene. KKR, Ares, and Owl all do private credit, but they don't really have any like direct relationship or direct competitorship with FG, which means that other than the private credit scare, itself, there's basically zero reason that FG would be correlated with them particularly. But they very much are. So, you know, you can see here and within that, like that should give you like some level of certainty to a certain extent. Like it should give you confidence one way or the other about the FG story when you see how closely the narrative is driving the price action. Because what that means is that like depending on what your take is on the narrative, then you should be like, okay, well the market is confirming that narrative. And so, well, I would say like either confirming the narrative or it's contrarying the narrative. So if it's confirming the narrative, that would be that you really do believe private credit is a big problem. If you believe private credit is a big problem and you really do believe the assets are bad and you believe the FG really does actually have those assets, well, then yes, it makes sense for them to be trading this way. But if like what I'm saying about insurance companies and what I'm saying about like the debt service coverage ratios and the leverage ratios of those software companies, as well as like the disaggregation of employment data that I know I've talked about previously as well, and a lot of those other things, well, then even if you think private credit isn't super good, you would still expect FG to not really be in the same bucket as them. But then you could also believe that private credit isn't nearly as bad of a problem, and it really is just a narrative thing going on. And at which point, after you could theoretically have both of those things going for it, that it doesn't really properly belong in the same bucket as the rest of these in this group. But at the same time, it also the assets themselves are probably better quality than people do believe. So it's like I said, it's sort of both of those things. I'm going to get rid of all these except for the weighted average one of KKR, Aries, and Apollo, because like I said, I do think because the only thing that those two would really have in common is the private credit scare itself. Like there's no coexisting relationship between how they're operating their business. Like that, yes, there's some relationship with the fact because like FG own private credit assets. So there's like they're running parallel to each other, but they're not like co-related to each other until private credit. And then suddenly it's just like whoop, almost one for one with this. So yeah, I think it's a sort of a good way to think about that within there. And then also, you know, it's worth noting, I wanted to point out that Chris Blunt did do another open market purchase of shares for FG again. Another really, really small purchase again. So, you know, he doesn't generally come out and make a huge swing. It's always like really, really tiny, small amounts here and there. So it's not like ginormous per se, but he did come out on the 13th and made a small purchase, 10,000 shares. Oh, also Doka Wang, one of the directors, also made some shares, but she doesn't buy a ton. So I don't want to like overly read into that per se necessarily. But I mean, she's bought in the past. So yeah, he continued to buy March 13th. Let's see where was the stock on March 13th? After a little bit of a dip down there, and it was also right before we had the pop-up, and it's worth noting the pop-up was when they announced a new buyback program. So he bought some shares, and then there was a buyback announcement. Hopefully there wasn't any like weird line tripping in terms of information on that regard. I feel like that could have been arguably a little close, but I don't know, that's for the SEC, I guess, to figure out. But yeah, also coming back over, FG has now put in place a $100 million share repurchase program for the next 3 years. So that is also a really good sign. Obviously, 100 million is not very large for like a $3.2 billion market cap or something like that. So it's not a dramatic amount. We're talking like, you know, 3% of the shares. But it's something. 100 million. I think it was like 200 million or 250 million was the share issuance last year, right? And the share issuance was at higher prices, right? So like if they were to actually execute this, in some ways it would be kind of taking back some of the pain that we experienced back last year if they were to go ahead and do that. And when I first heard about the buyback, I was initially like, yeah, I don't want to like get too excited about it because one, it was small, and two, I was like, well, we'll see how quickly they use it. Like, right, like I was like, we'll see, because they already had a buyback program in place, but it was very small previously, and they had like, I think they had like 60 million left on it or something right now, or I think they actually say in this article. Company's existing stock repurchase authorization permits aggregate repurchases of up to 50 million, of which 32 million remained. So you can see like they had 50, they had 32 million remaining, which means they used 18 million of it. So they used a very, very small amount of it. And like I had known that had existed, that they had used only a small amount of it. And so that's why I was like, in my mind, I was like, but they were so slow to use it last time. Who says they're going to use it this time? But I did investigate further. I did say, okay, well, let me think about this, because obviously they announced the buyback here. Like it just seemed like a really good, like I was like, huh, interesting that they announced it way back here when it was so low. So that's why I was like, well, wait a minute, when did they announce the previous buyback plan? And it turns out that they announced the previous buyback plan like here. Like I'm pretty sure it was this day right here. So it seems to me like maybe I wasn't giving them as much credit before because of like the small scale of it that they had done previously, but it seems to me like maybe they were actually paying attention and actually thinking about when they did their announcement, and it wasn't necessarily just like a flippant thing. And then also looking at this, I went and said, okay, well, that 18 million that they did, like when did they actually do the purchases? And they were it was basically like this following quarter, because the announcement came here at the end of Q1, and it was in Q2 and Q3. It was in Q2 and Q3. So Q2 is through here, and then Q3 is through here. So they basically bought a small amount of stock, but they did basically all their repurchases from here to here, in that vein. And then they did no repurchases in here. Like I said, they technically had more authorization in existence, but they did none, dropped down here, did none, issued shares here, pissed us all off because they did that. But they issued shares here, did none, drops to here, and then does a new authorization, right? Which this price here is now back in that range where they did buybacks previously. So like I said, it's still very small. It's still only like 3% of their shares. It's not, it's not a huge needle mover, but when I examined further, it did kind of make me feel a little bit better about their capital allocation. It did once again make me be like, okay, well, maybe they're not being super foolish about some of their actions here. Like I said, like it pissed us off when they did the share issuance. I made good arguments at the time as to why I thought that wasn't necessarily the worst move. Like I know why it pisses off current shareholders, but I made an argument for why their capital structure, equity versus debt, versus liabilities, and like how stuff like that works. I made arguments for why it was maybe a rational choice to do, but I also said that like if you were going to do that, you could also argue that you should get rid of the dividend, and then just kind of do it at a slower pace. And I mean, hell, I would have loved it if they announced the buyback, but also cut the dividend at the same time, and then just doubled the buyback, right? Like I've said it many times before that I wish companies were much more willing to turn a dividend on and off and turn a buyback on and off at a whim. Just be all over the place with it when you have the cash flow, like just be all over it. But like I said, the timing looks good. I'm happy to see that it at least makes it look like they were doing a buyback because they see the drop in price and they want to do something about it. And hopefully that means that they're gonna use it quickly. Like I said, like that's why like when I went back and I saw that they used it in Q2 and Q3 back here, that kind of made me think, oh, hey, maybe they will actually use that buyback here relatively quickly, assuming the price doesn't go up relatively quickly. Like if the price goes back up here again, they probably would stop because that seems like that's what they did last time. But if it stays down here, maybe they'll use the whole 100 million, maybe over the next year or so. I don't know. I don't want to get, like I said, don't want to get too ahead of myself because they were very disciplined. We'll be generous with the word choice we use. They were disciplined in the way they used it last time. So yeah, that's where I'm at with that. Interesting. Like I said, it was very interesting. I was not expecting a buyback announcement from them because, like I said, like their previous behavior had kind of just made me believe that we weren't really going to get much buybacks from them in general. We would probably just get dividends and capital appreciation. And to be honest, I didn't know necessarily how much cash flow excess there necessarily would be for buybacks per se, because like earnings versus cash flow for finance companies is difficult. And that's actually sort of a good segue to bring me over to back to discussing my model, because that's sort of one of the things I kind of wanted to improve upon was like a better way of thinking about cash flows for them versus earnings. Because the reason why this is difficult is because with a financial company, and specifically, when I say a financial company, I mean a company that takes in deposits of some form from another entity of some form. So if you take in liabilities that are expected to be paid out later, but those liabilities are are other people's property, but it's not like debt. It's not like you set terms and you set a specific interest rate. It's a different type of thing where like they have an account value that they could theoretically take from you. It's possible that the account value can change over time, like when you have like surrender charges and stuff like that, like FG has. But nonetheless, people can come to take their account money out somewhat at a moment's notice. There's limits on that. Like I said, it depends on the accounts, and there's charges and stuff and delays and things. But that's my point. They are a depository institution. They're an insurance company, an annuity company, insurance company, but that makes them a depository institution. And so the reason why that matters is because it kind of makes the normal way of thinking about cash flows not really make sense anymore comparatively. So like the normal way you think about cash flows is you go to the cash flow statement. It has earnings at the top, and then you're adding a bunch of like non-cash charges back, and you're subtracting out other charges, and then you have your change in working capital, which is a bunch of changes in like short-term assets and liabilities, and then that gets you your cash flow from operations, and then you come down here to the investing cash flows, and then there's usually some purchases of property, plant, and equipment, right? And maybe acquisitions, and maybe some purchases of intangible assets, and you subtract that from the cash flow from operations, and then that's your free cash flow, right? So if you think about that for FG here, coming over to FG, right? Like over these over these like 6 years here that we have, on average, let's start with earnings. The earnings on average for the last 6 years for FG was 358 million. 358 million. But if you look at the cash flow from operations, the average was 3.6 billion, right? So the cash flow from operations is 10 times higher than the earnings, which is not how most companies are, right? Like the cash flow from operations for most companies is usually like maybe 50% of earnings, maybe 200% of earnings, but it's usually kind of like in some sort of ratio range around earnings, right? Because it's based around the earnings. Like you're adding and subtracting things from earnings. So it's like, it could be for some companies twice as high as earnings, and it could be half as much, depending on the type of company we're dealing with and like where they are in their cycle and things like that. But it's usually close to it, not 10 times as much, right? And why is that? Because, well, obviously, like if you look in here very closely at like what's going on here, we have change in future policy benefits and change in funds withheld from reinsurers, which both of those are increases in liabilities, very, very large increases in liabilities, which relates back to that depository aspect of their business. And then again, coming down to the investing cash flows, we were saying the additions of property, plant, and equipment and acquisitions, that makes up on average about $57 million per year here. So if you subtract that from cash flow from operations, it's basically nothing. From 3.6 billion subtracting 56 million is almost nothing. So basically you still have $3.6 billion for free cash flow for the company on average over these 6 years. Now, again, the market cap of FG is 3.2 billion. If you add back debt and subtract out cash, if you take an enterprise value for it, it's 4 billion. So they earn almost their entire enterprise value in free cash flow in a year. Like you see what I'm saying? Like, does that make any sense? And the answer is no, it doesn't make sense, because that's not really an actually realistic way to estimate cash flows for this type of company. This 4.6 or this 3.6 billion you see here, it's a real number. Like that really is $3.6 billion in cash flow coming in on average per year from operating activities. But it's misunderstanding that because this is a finance company, you need to include the financing activities to a more complete degree for that to really make sense. And because those deposit changes, the increases in deposits and the withdrawals in deposits, they show up in the financing part of the cash flows down here. And so if you look at the financing activities for most companies, unless they're like a startup or a new IPO that's issuing shares at a very, very rapid rate or something like that, most companies have negative financing cash flows. They have positive operating cash flows, they have negative investing cash flows, and then they have negative financing cash flows. That's like kind of the normal cash flows that you look at. But here you can see that the cash flows for financing activities is positive. And the reason why is because we are taking in more deposits than we are withdrawing deposits. And so that creates a positive flow there. And then, yes, we're issuing debt and paying back debt, and we're paying dividends and things like that, and issuing stock. And those are the kind of the normal things you see in a financing statement. But those make up a smaller portion relative to the billions of account deposits per year. On average, 8.5 billion per year for these 6 years in contract holder account deposits. In contract holder account withdrawals, on average per year, it's about 5 billion per year. So that's like 3.5 billion net positive per year. And the average the cash flow financing level we're seeing here is 3.8 billion. So you can see that that's the vast majority of the financing cash flow that you're getting right there. And then in this case, like I said, like for a normal cash flow of a company, you would have to subtract out the investing activities, including like property, plant, and equipment, and maybe acquisitions if you wanted to be very comprehensive in that way to get a realistic understanding of what the cash flows are going on here. But in a finance company, that's not actually really relevant at all at the end of the day, because the amount of investing cash flows you're doing is entirely dependent on how much cash flow from operations comes in and how much net depositor activity you've got going on. At the end of the day, the investing activities is really just kind of like a net changeover amount, because what it is the buying and selling of investments, right? So like here you can see I've added up all the positive things, and so on average for these 4 years, because I only have it for these 4 years, you get 12 billion per year in investments coming due. So that's 12 billion per year in cash flow coming in from just investments coming in, like they've already matured and they're coming back. Versus down here in the outflows, in investing outflows, we have over that same period an average of almost 18 billion going out per year. So we were making 18 billion in new investments per year, 12 billion coming in, 18 going out. That means about 6 billion on average of investments that were being made per year. And that's basically just a plug amount based off of the amount of cash flow that we brought in from the operating activities, as well as the net amount of the contract holder funds that we had. Like both of those brought in money, and then we had to decide, okay, how much cash do we want to set aside, because that's our changeover in cash. And then the net amount left over determines how much investments you actually make there. And so it's compared to a normal cash flow statement, you get operating activities, and then you make decisions about investing activities, and then you make decisions about financing activities, and then the three of those things together determines your change in cash. That's how a normal cash flow statement works. But for a finance company, it does not work that way at all. It doesn't work that way at all. In fact, financing sort of comes first. First, you have financing activities. You have deposits coming in, and then because you have deposits coming in, eventually you have cash flow from operations, which is usually like coming from the assets bought from or I guess I should flip it around. I should say you have deposits coming in, and because you have deposits coming in, you make investments, and because you make investments, you have cash flow from operations coming in, and because you have cash flow from operations coming in, that means that now you can pay back some of those deposits going out, and then the net amount of those determines essentially how much of your changeover in cash and your investment outflows match up to your investing inflows. So like I said, it's just a very, very backwards way of thinking about cash flows compared to the normal company. And so as a result of that, when you're normally doing a valuation of a finance company, a bank, an insurance company, the normal way to think about it is a lot of people just use earnings. A lot of people just use earnings as sort of their proxy for what their cash flows are going to be, and they're just going to put a multiple on the earnings, then that's going to be how they do their valuation. But I've done that a lot, and I understand how that can be a valuable shortcut, and how you can be conservative in your approach to doing that, and also how that's a perfectly fair and reasonable approach. That there's not necessarily anything wrong with that. They just have to understand the limitations of doing that. But nonetheless, because of all the concerns around private credit and stuff like that, and all these like outflows and investments and this whole scare related to these things, I wanted to like really, really try to like do a better, more thorough job of understanding like where the money flows on a yearly basis, not just on a general basis. Because I had also like still tried to understand the flows of the business previously, but I had always used a different approach, which is to say, here, hold on. Let me find a specific table that they have here. So now they have a table like this in most 10Ks. This is a pretty typical table to include in a 10K, but for most companies, it's not really like a huge feature. It's just kind of like an extra feature that you might look at because it usually doesn't have a ton going on in it. But for a depository company, especially an insurance one, this becomes a very interesting, more useful feature, which is the obligation section. It's often near the end of the 10K, but in this case, it's actually pretty high up in the 10K. Usually it's one of the more last notes you'll see, but there's commitments and obligations table, which is often shown like this, where it shows basically like the next 5 years, and then it has like a thereafter, and then it has a total. And so it includes basically like payments. These are like contractual obligations that exist for the company, that you can know that this is cash that has to go out the door due to their contractual obligations for the company. And like I said, it shows here the first 5 years, and then it kind of just has like a thereafter. And I usually just like assume that thereafter is like another 5 years. So it's like a 10-year period here. You can divide this by 5, and it tells you essentially like what the average of those last 5 years would be, sort of on average, which is fine. You can it's to give you information for the next 5 years is kind of the focus of it. But you can see like the things that are included here: notes payable, principal repayment, operating lease payments, annuity and universal life products, pension risk transfer annuity payments, funding agreements, FABN, FHLB, interest on fixed rate notes payables. So like these are things where there is like a contractual obligation that money is going to go out the door. That doesn't mean it's all the money goes out the door, because it doesn't include things where the contractual amount isn't known, right? So what this is like the principal payments on the debt. So they have notes payables, that's their debts, and they know that those debts come due in 2028, 2029, and then they have 1.2 billion that comes due thereafter, right? They have leases. They have to amortize their lease. They're expecting to pay 2 million per year in leases, and that's a contractual obligation. But in their annuity products and in their pension risk products and in their funding agreement products, those are all products they sell. So those are all liabilities that they've built up because they have those sales there. These are contractual amounts that they expect to pay out over this course here, right? So this is something that you can use to get an idea of, okay, like how much cash flow has to go out the door in terms of those financing withdrawals, right? Like this is financing withdrawals, contractual levels of it. Now, this isn't going to be the total amount of it, like I said, because it doesn't include anything that you can't estimate on a contractual basis. So this doesn't include the index credits that would occur over these 5 years. All this tells you is what the liabilities were at the end of 2025. What would the contractual payments be like as the annuities mature and as the pensions payments come due, and as the funding agreement terms come due as well. And then also they include the interest on their notes payable because that is a contractual obligation as well. So in fact, like I said, as I was saying before, most 10Ks include this table. It's just usually a much less important feature because for most companies, the principal payments and the interest payments and the lease payments would really be the only thing in here, unless they have like maybe some weird idiosyncratic payments, like maybe like some sort of like legal payment that they have coming due or something like that, right? Maybe some weird other thing there, but like usually it's not like a big amount, right? Like 10 billion, 10 billion, 12 billion, 10 billion, 8 billion, and then thereafter, which like I said, you could sort of divide by 5 is 60 billion. So if you divide that by 5, that's like 12 billion per year on average for years afterwards, if you use that kind of logic. So you can see huge amounts. Again, the market cap of the company is 3.2 billion, right? So huge amounts of cash flow. There's multiples of the market cap on a gross basis that have to go out the door here due to this table. And like I said, that doesn't include the index credits. So if you assume that the index credits are going to credit the accounts on average, like 3.5% maybe per year on basis, then you would have to take that into account too. You would have to say, okay, well, if coming over to their total liabilities, and actually liabilities less debt, because we know that the debt isn't going to have an index crediting to it, and technically not all their liabilities too, because like taxes payable, accounts payable, deferred tax liability, those technically wouldn't be included here, but just to keep the math simple, I have this liabilities less debt line here already, so I'm just going to use that as my tool. But it's about 91 billion or so, so let's say 91 billion, and let's just assume it's about a 3.5% crediting rate on average. That means it's going to be like about another 3.2 billion that you'd have to add on to those commitments, and like I said, like it would technically be amortizing, so really it'd be like 3.2 billion added onto the liability amount as of 2025, and then technically whatever the pro rata share that these payments are of the 2025 amount are, you would have to take that pro rata share as of that total amount for 2026 and make that be the actual outflow, and then you have to take the charge against the 2026 amount, so on and so forth for each year, so forth. So there would be kind of like a compounding effect that you would have built into this, but so it might be like 3.2, 3.3, 3.4, 3.5, so on and so forth per year. It would kind of like build up a little bit over time, and then technically that also assumes more sales are not coming in. Like this assumes that no sales are coming in, so like at the same time you would have like gross sales coming in, which coming over here to down here where I have to gross sales per year over the 6-year period has been like 11 billion per year. And then net sales, which actually is a closer estimate to what happens with their liabilities, has been 8.6, 8.7 billion per year, right? And so like, for example, as I was talking about like the cash flow from operations, I was saying earlier how it's very bizarre how like the cash flow from operations is 10 times larger than the earnings, whereas for most companies it's like half as much, maybe twice as much, or somewhere in between there, where it's 10 times as much. And the reason why is because the cash flow from operations more closely relates to those sales numbers than it relates to the earnings, because the earnings relates to the revenues, and then the revenues are recognized usually based off of what's happening with the assets and liabilities. They're not based off of like when they made the annuity sales, which is why they try to differentiate in their numbers between their revenues and their sales. The revenues is like the GAAP number that you normally think of at the top of an income statement, whereas the sales is basically the agreements that they've made with their customers. Like this is like the gross amounts of the agreements that they've made with their customers, and then those numbers show up as liabilities on their balance sheets for the most part, and then those liabilities move off the balance sheets on a regular basis through like I said, this kind of regular commitments that they have processed there. But then also part of that commitment is that those liabilities get credited higher and higher based off of what happens in the market, and so on and so forth. So they have contractual obligations in liability form on their balance sheet, and those liabilities on an annual basis, or actually it's more like a quarterly basis, get bigger and bigger and bigger. And then they have the assets on their asset side of their balance sheet, which they purchase with the money that their customers gave them, and then they're hoping that the income that they earn both through the assets, the interest and investment income, but also through premiums that they charge to their customers. So like they're also charging them premiums for doing this, and other fees as well. So basically the combined amount of the premiums and fees plus the interest in investment income, that makes up what their actual recognized revenue is. So that's why, like I say, is like the gross sales has nothing to do with their actual revenues. So you can see, because like the revenues come in at sort of like a delayed basis. Like the revenues, some of them come as a result of their assets, which is like their interest and investment income, but other parts of them come from their liabilities, which is basically like the premiums that they're charging to their customers here. But then there is one part of their revenues though, the PRT premiums, which does come directly from the sales. Those are almost directly related to that. So in a sense, their revenues are kind of mixed between like 3 categories. There's like what I like to think of as their asset-based revenues, there's their liability-based revenues, and then there's their sales-based revenues. And in a sense, it's almost like a third mix between each of them. I kind of mixed the gains and losses into the asset-based revenues, because in a sense, those are, gains and losses against the assets, right? And like their own distribution revenues, I count those as asset-based revenues too, because those are basically them getting a cut of the business that they purchased on their balance sheet, which is the own distribution. So that's kind of like how I think about it on here. So now that we kind of talked about that, I can sort of explain this model, because I think like now that you sort of have like a workings of like how their business works and like how that relates to their three financial statements, I can kind of explain like how the pieces themselves sort of fit together here in this, because there is a lot going on here. So let's start with gross revenues. Sometimes I forget which order they're in. So here I have the gross revenues here. As I said before, over the last 6 years, it was about that's the subtotal. Over the last 6 years, it was about 11 billion or so on average that they had in gross revenues. For the last 3 years, on average, it's actually been more like 14 billion, 14.6 billion in 2025, just to give you a sense of it. And then, as we've talked about before, they use reinsurance as a way to essentially have a smaller amount of these liabilities held on their balance sheets relative to other companies, so they can essentially like offloading some of the capital intensity to other companies, and they're paying fees in order to do so. And so that's why they have this kind of like this negative amount here, which for the last 6 years on average has been about 3 billion or so. They only really started doing this in 2021. 3 billion or so. For the last 3 years, it's been 4.8 billion or so, and then it was actually over 5 billion for the last year. So like the percentage of their gross sales that they've been sending off to reinsurance has actually been growing over time. You can see it was 0 in 2020, it's 9% in 2021, then 20, then 30, then 31, and then 31% again in 2025. So you can see it's been accelerating over time, and this relates back to the reinsurance sidecar that they said that they opened up in I think it was Q3 of last year, and then also them selling off the Bermuda reinsurance portion of their business that they did after the close of Q4. They talked about both of those actions are essentially to open up more pathway to increase this over time. Not to necessarily increase the percentage, because like the nominal amount, they have to create new relationships to just increase the nominal amount of it, but hopefully increase the percentage. I do believe they intend to increase the percentage over time, probably not at as rapid of a clip as they've done historically, as you can see here, but they would probably intend to do so somewhat over time. So coming over here, I actually have it growing from 31% here in 2025 over the next 10 years up to about 38-39%, which is basically an increase of 2 standard deviations over the average, which the average is below where they currently are at 28%. So that's kind of like how I have modeled that to go to. And so that's how I'm handling like the distribution between the gross and net portions of their sales, which relates back to how some of their liabilities work out. But then the question is like, okay, well, what about the sales themselves? Which that relates back to what's been happening in the industry. So I do have like the different portions of their sales that they're the industry totals. So index annuities, fixed rate annuities, index universal life, IUL, funding agreements, and PRTs are kind of like the different segments that they're in, which make up different portions of it. So the total size of the index annuity industry in 2025 was about 190 billion, and FG had about 3.5% share. Fixed rate annuities, 167 billion. FG has 2.3% share. IULs actually a little bit less than $1 billion, and FG actually has a 20% share in that particular sub market. Funding agreements, $280 billion market. FG has 0.7% share, less than 1%, and growing fast though. And PRT is $48 billion in 2025, and FG has 4.4% share. So within these, some of these industries I expect to grow more than others. And so this model is designed in a way where I can essentially scale up and down how fast I think each of these markets is growing over the next 10 years. And I could change also FG's share as well, but for the most part, I've kept the shares pretty even. With like only minor tweaks to that. But for the most part, so if I want to change the revenues, I'm probably just going to adjust it based off of what I expect to happen with the industries as a whole. But looking at that, if I just add them all together, the industries that FG participates in as a whole in 2025 was about $710 billion worth of industries, of which FG has about 2.1% market share. And so I'm assuming that industry is going to grow by about 50% over the next or actually more than 50%, less than doubling though, like more than 50% less than doubling, maybe about 75% over the next 10 years or so. And FG is going to still have about a 2% market share. So maybe a slight decrease in overall market share, but like but overall. And like I said, I've like fine-tuned each one individually, but I don't need to really get into the specifics of that. Really, I want to focus more on like how you build up the the cash flows of FG more than I focus on like the industry stuff. I've talked about that stuff many times before, to be honest. So yeah, within that though, but yeah, so that's basically like how we're getting our sales assumptions here. I'm assuming their industry is going to grow at about 1.2 trillion, and I'm assuming they're going to get about a 2% cut of that. And overall, that means that 10 years from now, their gross sales would be about 24, almost $25 billion. And then, as I said before, I expect them to attribute about almost 40% of that to reinsurers, which means their net sales would end up being about 15 billion or so. And just to give you a sense of comparison, their net sales in 2025 was about 10 billion. So I'm essentially saying that that would grow by about 50%. Like their gross sales would grow by about 75%, and their net sales would grow by about 50%. And again, these sales have no real relation to revenues, because that relates to like how that functions in terms of their balance sheet, which we'll get to here shortly. But coming over down here though, within that, as I mentioned before, pension risk transfer sales do tend to relate directly to the sales here. They have like a pretty much one-for-one relationship. So the PRT sales that we're expecting up here do come down directly into the revenues as a percentage of PRT sales. And so that's what I mean by sales-based revenues. So within that, we would end up with we go from 2.1 billion in PRT premiums in 2025 up to 3.9 billion in PRT premiums in 2030, which is a pretty big portion of the jump in revenues as a whole. But then they do have other premiums, surrender charges, which those together I kind of call the liability-based revenues, which as a percentage of their liabilities less debt is less than 1%. And overall, I'm expecting that to remain pretty steady, but maybe decrease as a percentage of liabilities less debt, because I expect there to be less surrender charges overall relative to the higher levels we've currently had. But overall, this gets us our life insurance and premiums portion of our revenue going from 2.8 billion in 2025 to 5.6 billion or so in 2030. So you can see like that's basically like half of the revenues right there built up. You can see how I kind of put those together, where like half of that came directly from the sales, and then kind of like the other half of that came off of the liabilities essentially. And then that makes up basically about half of the total revenues. If I come back up to the income statement, that same number feeds in over here to the life insurance premiums right here. And then, like I said, we still have the asset-based revenues, which includes the interest and investment income, but also includes recognized gains and also includes the own distribution revenues, which as a percentage of assets, less cash, this should say less cash. Or no, it's not less cash. It should include cash because there's cash interest in there. My bad. As a percentage of assets is 3.2%. So yes, I know like FG focuses on their yield over their assets under management or whatever, you know, and that they have their measures. I'm using my own way of measuring this. So don't think of this 3.2% as any way related to their like 5 point something percent that they report, because I'm including the total assets where they're including only a portion of it. And I'm including more than the interest in investment income, whereas they're only including the interest in investment income too. So that's another difference. But 3.2% is what it is currently. On average, it's been a little bit higher than that maybe. And I'm seeing them, it maybe even go down. I'm actually arguing that this could maybe even go down due to maybe the spreads that they get on their investments being less over time, even though their own distribution should increase as well. So like in some ways, this is probably a very conservative aspect of the model that I put in here by having it go down as a percentage of assets. But overall, that makes it go from 2.9 billion to 6.9 billion, which makes their total revenues go from 5.7 billion in 2025 to 12.5 billion in 2030, which is a little bit less than a double. It's like, what is that? Like 85-90% increase or something like that. So then also looking at the other expenses, you'll see that I kind of split off the expenses similarly to how I did with the revenues, where I did asset-based revenues, liability-based revenues, and then sales-based revenues. I did basically the same thing with their expenses, where I have liabilities-based expenses, which is like their benefits and other changes in policy reserves. We do that as a percentage of the liabilities less debt, because that's basically like as a percentage of those deposits, what are the benefits that they're accruing. This is sort of like the crediting rate. This is the credits. It includes more than just the index credits, but it includes the credits. But then also we have asset-based liabilities, which is like their market risk, benefit, loss, and gains, but also the depreciation and amortization. That's sort of an asset-based liability. And I wanted to have like kind of limit the total amount of assumptions. So that's why I'm like grouping these things together as well. And so yeah, asset-based liabilities as well. You can see liabilities Benefits as a percentage of liabilities less debt is like 5% or so per year. So 5% of the liabilities less debt has to be credited as an expense to those annuities as a whole. But then about 1% of assets less cash also has to be credited as an expense due to those assets becoming worth less over time. And then there's also sales-based expense, which is what I'm including personnel costs as well as other operating costs, which we're going to do as a percentage of gross sales rather than as a percentage of revenues. Like for most companies, I would usually scale those kinds of things as a percentage of revenues, unless I had something other more specific. But in this case, like I said, like in a lot of ways, it makes more sense to think about gross sales more than it makes sense to think about the revenues. So that we're going to do that here for that, which is about 3%. So you can see, like, because of the fact that I'm scaling all of these revenue items as well as these expense items to things different than the normal revenue way of scaling things, I think we end up probably having a much more robust and kind of accurate way to think about like the growth of the expenses of the company, not just the revenues, but the expenses of the company relative to the growth of their balance sheet. And so that's what you'll see, like by the end of this model I'm putting together, I've put together all three models. You know, like normally when I do a model for a company, the vast majority of the time, I'm just modeling out the income statement, right? Like I just want to know the revenues and probably the operating expenses as well. And if I can model all that out, then I'm pretty happy with that. And sometimes I do want to know some things about the balance sheet. Like sometimes I'm trying to model out at least like the overall size of the assets, right? Or something like that, so that I get an idea of like how their return on assets is or return on capital and things like that. But usually you're just focused on the income statement when you're making a model for a company. But in this case, I was like, no, I want to model out the income statement, but I also want to model out the balance sheet and make it so that it's consistent with the income statement, meaning like the equity grows at the same rate as the income comes in, right? And also I want the cash flow statement that's consistent with it as well, that shows like the change in cash on the cash flow statement is the same as the change in cash on the balance sheet. So you can see what I mean. It's like I want all three statements to actually be fully linked together, a full 3-statement model for FG, which is basically what I've done here. So yeah, coming down further, or actually we'll be skipping past this because now that I've explained sort of the expense items here, the operating expense items in here, let's skip and actually go and take a look at the cash flows. And so you can understand like how the balance sheet is put together so we can kind of do the rest of it. So within that, like I said, we have the revenues and down to the income, and then coming down to the cash flow statement, as I said before, normally you're focused on like the earnings and then adding a bunch of stuff back. That's how you build the cash flow statement. I chose to make it a little bit simpler on myself, where I'm basically saying like, we're going to just take the operating cash flows as a percentage of gross sales. Like how much of the gross sales do we get to keep as operating cash flows on any general year, which is 35%, generally speaking. It varies a decent bit, but it's about 35% or so. So I'm just going to hold that generally steady and use that as my logic. And you can see it actually has been growing over time, 4%, 19%, 28%, 44%. So it went up a little bit and then down 39% and then 32%. So I am assuming that it's going to grow from 32% upward a little bit over time. But for the most part, it's pretty consistent around this kind of like mid-30s kind of range. And then also keeping in mind within that, when we say operating cash flow, this technically it's not the same thing as like, because like what I might have wanted to do is I might have wanted to start with earnings and then say, well, let's keep the personnel costs and let's keep the benefits and let's keep the other operating costs because those are like kind of cash things that we have to do. But the truth is we don't actually know how much of that is actually cash. So that's why I say we don't really want to start with this earnings number because we have really no idea how much of this is cash. It is very, very impossible to differentiate the cash level of this compared to like how you could normally go up to like an EBITDA number with this. EBITDA would not be very, very telling for us with this. You can do it, but it's not super, super telling. So that's, like I said, I'm just going to start with the cash from operations as a percentage of gross sales and then use that to scale into gross sales based off the future. And then I'm also going to take a look at the financing and the investing activities a little bit differently too. So I have contractor holder deposits as a percentage of net sales. And this ratio you can see is about 95% over time. So it's pretty much the majority of the contract holder account deposits can be explained by net sales. And we want to use net sales here instead of gross sales because that netting takes out the amount that's being sent to the reinsurers, right? So it's not being deposited to us, it's being sent to reinsurers. And so that's why we're focusing on net sales for this one. And so that means that we can actually model this in the future from our sales estimate pretty easily since it's pretty consistent. And we would assume that it's been kind of growing over time too. So we would assume that actually it kind of levels out at about 100% generally over time. And then down here, the contract holder withdraws. This is a little bit harder to model because technically contract holders can withdraw things themselves of their own accord outside of the contract terms. But nonetheless, we can still kind of model it out to a certain extent, which is to say that like FG actually reports the average duration of their assets and liabilities in their 10K. They do it each year. They give an estimate, and the estimate bumps up and down a decent bit year to year. But it has a pretty close average. Like on average, their liabilities have about a 5.2% duration, and their assets have about a 4.9% or 4.9 year duration. And it currently, as of 2025, is 5.2 and 4.5. And you want to have a shorter asset duration, so essentially your assets are coming due before your liabilities come due. That's essentially like you want to have a buffer there. But like I said, obviously you can withdraw as well, so that technically messes with that math a little bit. But nonetheless, the point is like based off this, they have an estimate already here to say, okay, well, we know how much liabilities we have, and we know the duration is about 5.2 years. That means you can estimate per year how much you would expect to be coming due. And so in the cash flow statement, I've done that. Here I have liabilities less debt to duration, so divided by duration. And that means here I've estimated essentially how much I would expect to be coming due per year for each of these 4 historical years here. And then I compare that number to the actual amount of contract holder withdrawals that are being done here. So I take the ratio between the two, and the ratio ends up being actually about 58%, which what that suggests is that there's actually a lot of people that roll over their withdrawal back into a new annuity. That's what that tells me, is that happens a pretty significant amount. And so I would expect that to happen less over time, but the point is that gives me a way to essentially model out what the withdrawals are also going to look like going forward into the future. And so if I've now modeled out both the deposits and withdrawals, that means I now have a net amount for the deposits, and I can make an estimate of what my dividends would be. I can make an estimate of what my distributions to non-controlling shareholders would be. I can make an estimate of what I can also make an estimate of what my debt is going to be, because the company tells me that they specifically want to hold about a 25% ratio of debt to total capitalization, with their total capitalization being debt plus their equity plus their accumulated other loss. And so I've done that. I've kind of made that estimate over years within the projection over the next 10 years. And then I have it so that by 10 years from now, it does equal 25%. It's currently about 26%. So they're not even that far from their own desired leverage ratio, basically. But the point is that would change over time as the balance sheet changes, due to them having more sales. So the point is I can change that as it happens. And so within that, because we know what the debt is going to be each year, that means that in the cash flow statement, I can therefore net out the payments of debt that we would have to do. So on net, we would be paying out very, very tiny amounts of debt, and then we would start issuing small amounts of debt you could see per year here as we grow our balance sheet, so to speak. And so basically with that, I've now modeled out completely the operating cash flows, and I've now modeled out completely the financing cash flows, which only leaves the investing cash flows, which is interesting that we're doing it backwards. Like I said, with most companies, you would model out the operating cash flows, and then you'd make an estimate of investing cash flows, and then that would tell you your free cash flow. But in this case, I kind of have to work backwards. I can model out my operating cash flows, and then I model out my financing cash flows, and then I also say, I did the estimate. I said, okay, how much debt do I want to have 10 years from now? But I can do the same thing with cash too. I can say, okay, how much cash do I want to hold 10 years from now? And I look at the balance sheet, I look at their historical balance sheet, I look at the cash levels relative to assets, and it's generally been about 2% of their assets. And I'm doing it as a percentage of their assets because I think of the cash they hold as essentially the cash that they need to hold for liquidity reasons to be able to meet their liabilities obligations. So we want to make sure they're holding the appropriate amount of cash that they've held historically for liquidity reasons. So held constant as a percentage of assets. So that's generally what we're going to do over time. So with that, I can estimate what I want the cash to be. And if I know what the operating cash flow is going to be, and I know what the financing cash flow is going to be, and I know what the change in cash as a whole is going to be, then that means I can work backwards to figure out what the investing cash flow is going to be. And then with the investing cash flow, I do the same thing I did with the liabilities, where I compared the duration of the liabilities to the current liabilities. I do the same thing with the assets. I say, okay, my current assets and the duration that they say that their assets are, I make an estimate of how much of those assets would be coming due each year, and I compare it to the actual amount of investing inflows they get, which ends up being about 70% or so. And then that means I can use that to project for the next 10 years. And that means I can then use the basic algebra to work backwards to figure out how much investing outflows there has to be. And the reason why I want to do this, because there's a lot of steps there to do this. This is useful because it's actually sort of a sanity check. I can look at my gross sales that I've projected for the company, which is based off of what I think is going to happen in the industry, and also what market share I think FG is going to have. So this is one estimate I've kind of done based off one level of analysis. And then I can, which like I said, is about a 50% increase in net sales and about an 80% increase in gross sales, which I'm comfortable with that estimate. And then I can compare that to my growth in revenues, which my revenues grow like 80%, 90% as well, which I'm comfortable with. And I can compare that to my growth in assets, which go from 98 billion to 260 billion. So that's like more than a double. That's like 125, 130% increase, which I'm comfortable with. And compare that to the growth of my liabilities, which goes from 94 billion to 250 billion. So more than double, like 130% increase or something like that, which I'm comfortable with. And all of those things compare to the, like I said, the average investing outflow that I saw for the last 6 years was like 15.7 billion. And if I compare that to the average investing cash flow that I'm going to see for these years, which ends up being 29 billion, it's a little bit less than a double, right? It's a little bit less than a double. And it's consistent with those less than a double, about a double, just about a double, as all those other estimates. And this estimate is a little bit more independent from all those other estimates. So the point is, like, this becomes a sanity check. The fact that this number makes sense compared to all those other numbers means that I think my estimates are all reasonable. They all make sense, which makes sense because, like, for the most part, I just kind of reverted to average. I basically just like mean reverted to like what happened historically for all these estimates, and then I kind of tweaked it from there based off of small amounts of things that I do know. Like, for example, I know that they're going to do more pension risk transfer business than other parts of their business over the next 10 years. I know that they're probably going to get less investment income relative to they've done in the last 10 years. I know that they're going to have to pay out higher levels of index credits probably over the next 10 years as their customers get older compared to the last few years. And so I've been able to tweak things according to all of those assumptions as well, but nonetheless, everything still makes sense here. And then last but not least, the last of those sanity checks things, the things that really kind of makes it show that everything makes sense here, is that I do have it all come together, like I said, with those the revenues and the expenses to an earnings estimate here. So in 2025, GAAP earnings of 248 million, and also GAAP earnings on average for the last 6 years of about 350 million. Whereas I have GAAP earnings going from 144 million in 2026 to 971 million in 10 years from now. Now, don't focus on what it is in any individual year, because I would say like that doesn't really tell you too much. I would say focus on it more like on average over a 5-year period or so. And so you can see like over the next 5 years, I'm saying GAAP earnings of about maybe 204 million, which really isn't, it's actually less than it was in the last year. That's not very good. But over the next 10 years, it's more like 427 million, which is higher than it is in the last 5 to 6 years. And also keep in mind, this is GAAP. I'm estimating a GAAP number here, which is generally about 15 to 20% lower than their own adjusted earnings estimate. And then in the back half here, I also have the second half being 650 million, right? So you can see that we have earnings growth. It's earnings growth that we're seeing here nonetheless. And like on average, we're seeing growth. It's just like in any individual year, it's not necessarily going to show you a good number. And the reason why is because, like I said, it does link up to their balance sheet. And so it does have to add up all together on their balance sheet. And it does. Like if I look at here at the book equity for common shareholders at the end of 2025 was 4.8 billion. 4.8 billion. And you can see I have it essentially how I arrive at the book equity is adding together all these things, including retained earnings. And retained earnings is last year's retained earnings plus net income minus dividends. That's basically how we arrive at our book equity. And we do have subtracting buybacks as well, but I don't actually have any buybacks modeled into this cash flow statement. So the point is like this book equity does model out exactly what you would expect to happen with book equity over the course of that 10-year period. And that also basically has about a doubling, going from, like I said, 4.8 billion here at the end of 2025 up to 9.2 billion in 2035. So a little bit more than a double or so. So everything's consistent within this. I feel pretty happy with that. And then also, like I said, one of the reasons I did this whole exercise was I was trying to come up with a more rational way to think about cash flows for the company as well, because cash flows are just very hard to think about for a financial company because of the fact that you can't take cash flow from operations and then just subtract out operating investments and then still get there, because financing deposits are usually a big part of a financial company, and they are for FG. And then also, because you have large financing deposits, you usually have huge finance investments that you're making, like actual securities purchases and stuff. And so you have to account for that as well. And if you just subtract, for example, the investing cash flows from operating cash flows, that's not going to give you a satisfactory answer either, because like I said, if you just do that here, you're usually going to have just a completely negative number because you haven't accounted for those deposits yet either, right? So like here, you'll see it's going to be a negative number all those years. And you might say, okay, well, I'll just add in those net deposits then too. Why not just add that in and ignore the debt and the dividends? And like that is one way people do that. Like that is another approach. Sometimes people think, oh, I added the wrong thing here. Hold on. There we go. Yeah, so if you did that here, that isn't one way you could do a finance free cash flow. And you can sort of see like that sort of gets us to something that maybe makes rational sense, but it's still negative for all of these years. And that the reason why is because they're growing their business. They are still making net larger amounts of investments than they are even in terms of the deposits they're making. And that's because they are still building up their debts and not paying out huge amounts of their earnings in order to add even larger amounts of assets relative to their liabilities. And so like if you make an estimate that way, you get positive numbers in some years, but still on average over the course of over 2, 3, 4 years on average, you get kind of a negative number. So it doesn't really help you make an estimate for the future necessarily, though you could still do that for the future. And if I do that for the future here, we still get a number that somewhat makes sense. So like here you can see it ends up being like 350 million or so on average is what I get for this estimate here. And that's versus my earnings estimate, I got 427 million. So 427 million of an estimate of a GAAP earnings number on average for 10 years versus an average estimate of cash flow of 350 million or so. But I do have two other ways of estimating cash flows that I kind of wanted to discuss as well that I like, which I have here. One version of it is to come up here, is to start with change in cash, right? Because like if you're increasing your cash pile, then that's obviously, first of all, that's real cash. First of all, that's actual cash that we know is cash. And it increased, which means obviously you didn't need it this year, right? So let's add the increase in cash and then also subtract out also add in buybacks and dividends, because if buybacks and dividends are actual cash that was actually paid out, so change in cash plus dividends plus buybacks, and then also include the dividends and distributions from the non-controlling interest, because that's theoretical cash flow that if they didn't have that equity issue, that would be cash flow. So that's something that you would want to include there. But then also include interest expense, because interest expense is the cash flow that was paid out to the debt holders. And so if you add those two together, that gives you an estimate of free cash flow as well, which this estimate is like 590 on average for the 10-year period. So you can see that estimate is even larger than the earnings estimate I have. The earnings estimate being being 427 on average, and then 590 being the average for that, shows you that we would have cash flows that are higher than the earnings estimate. And by the way, that actually makes sense for you to have cash flows higher than earnings for this type of company, because we're in good times, and in good times we should be bringing in more cash than the earnings, because the earnings includes those charges to expected losses that I was talking about earlier, and those expected losses are expected to be drawn down on later during the bad times, and that's when you would need that cash. So you would be expecting to essentially be building up excess reserves of cash that you're not really counting as cash on your balance sheet. You're kind of, because you have liabilities counted against it, but you're going to use that once you need it during the bad times to actually pay out those claims. But then another estimate is, there's another way you can estimate this kind of backwards way of estimating a cash flow, is to then just start with the earnings and then add the interest expense back. And that's sort of like thinking about like EBITDA, right? Like EBITDA is sort of like a cash flow measure. Like EBITDA is sort of like an operating cash flow measure. So if we start with earnings before interest, we're not going to add taxes back, because taxes do have to actually be paid. That actually is an actual expense that has to be paid. So we're just going to leave taxes in there. And then we're not going to add depreciation and amortization back either, because while that's a non-tax thing, a non-cash thing, and so you could add that back, I would argue that because of the fact that those depreciation and amortization charges come mostly from them acquiring other insurance businesses, and also related to those own distribution acquisitions as well. That means that this growth that they're experiencing here is probably going to include a lot of that depreciation and amortization. So we're going to leave depreciation and amortization in this estimate, because it's going to sort of be our proxy for actual investment. It's just like a proxy for it. And it's probably a conservative proxy too, by the way, because it might honestly only be like half of that depreciation and amortization. But this estimate right here, on average for the 10 years, gets us about 605. So one of the estimates is like 590, the other one's 605. I take an average between the two for each of the years, because one of them is actually higher in the short run and the other one's higher in the long run. So I think it's sort of like a good balance between the two. But that's actually my estimate of like what free cash flows would be for the company over the next 10 years, which gets you a little bit less than 600 million, as I said before, about 600 million or so, relative to, as I said before, about 430 million in terms of earnings that I would expect. And that's relative to, on average, like I said, about 8.8 billion in revenues on average for the 10-year period, but ending at about 12 billion or so. So that's my model for FG. It's, like I said, very, very comprehensive. We modeled out all three statements, and like there's a lot of assumptions that goes into every this. I'm not going to pretend that that there isn't like massive caveats to those assumptions. But like I said, the whole point of the exercise is to essentially try to get to the end here, and have a 10-year forward revenue number, a 10-year forward earnings number, a 10-year forward asset size, a 10-year forward book value estimate, as well as a 10-year estimate on average of free cash flows relative to those earnings, that all sort of make sense, that all kind of balance out against each other if you understand like basic accounting principles. And these assumptions all do work well together. So with that, coming over to my actual like DCF template that I use, the one that I have for all my finance companies, FG here, I have it doing basically exactly that. I have it accelerating towards about 12 billion and change in revenues in 10 years from now. I have it being slower here in the short run, because I just want to be a little bit more conservative in the short run. And then also I have operating expenses moving towards consistent with what we saw in that modeling as well, getting us to our net incomes of like 100 million change up towards 9 million and change over the long run, on average being about 400 and change or so. And then well, we do actually have buybacks in place for this, but that comes back to like what I do down here, you'll see in a moment. But for dividends, basically consistent with, they were already growing. We have them growing at like a decelerating rate, but still continuing to grow. For a trailing multiple, trailing multiples, it's a little bit tricky to look at, because if you look at their historical trailing multiple, on average has been like 12, and that's because the trailing multiple against their GAAP earnings, not their adjusted earnings, which most of the time if you're looking at like multiples online, it's looking at their adjusted earnings. So I'll point that out, that I'm talking about GAAP multiples, which means because it's a lower earnings number, the multiple itself is actually going to be higher. And that's not because I'm giving them a high valuation or anything. That's just making it apples to apples.
So it's on average been about 12. So I have it going down towards a 10, which is more conservative and just kind of like taking into account like the uncertainty that's currently around that. And then with the cash flows, I have the cash flows equaled out to roughly equal to what I was saying before, about 500 and change relative to the 400 and change of earnings that we have right there, and ending at about 800 amount right there. And then I give it about a 7.4 cash flow multiple relative to that, and that means that the discount rate across all 10 years overall ends up being about 9.5% overall. And then, like I said, kind of a trailing multiple assumption baked in there of about 7.4 of a multiple within that. And then also for the cash assumptions, for my valuations, typically what I like to do is assume that the cash stays at a similar level of expected as a percentage of sales, and then whatever amount above that, basically I feed into buybacks, coming back up here to the change in share amounts relative to that trailing multiple. And that's because I do like to kind of there's looking at like the cash flow valuation upside and the expected returns based off that, but I also like to look at like what the earnings themselves would do and like what multiple I would put on the earnings, and then an IRR relative to the collection of dividends and those earnings. So it's sort of like two different ways I do a valuation here. It's like an earnings based valuation, an earnings based IRR valuation versus a cash flow based COGR valuation, and then I sort of take like an average between the two in terms of what I think about my valuations. And I like doing this because this kind of allows me to think about cash flow, earnings, buybacks all together, kind of all at once. But within that, like I said, normally I'm kind of trying to leave cash in there relative to what they have as a percentage of sales. But as I was saying in my model, I'm actually trying to think about it relative to assets. So instead here, what I had about 4.2 billion in cash being my ending value of total cash that I have on my balance sheet for liquidity purposes. So within that, I did the same thing. I left about 4.2 billion in terms of cash and investments left on the balance sheet here. And then the net amount, like I said, I kind of had already decided a dividend growth rate here. But then the net amount is I just kind of put into buybacks, which got us on average over the 10-year period, got us about a 2.6% COGR of share decreasing. And I do have it weighted towards the back end. So I have much slower levels of buyback up front. And then I just have it accelerating towards the end there, which is pretty typical of how I handle my valuations here, where we're conservative on the front end and then really have the juice showing up in the back end. But within that, you end up with on average kind of like teens levels of income based valuation. Like I said, that kind of like earnings and buybacks and multiple based valuation, I kind of get like mid-teens percentages depending on what year you hold it for, because that's one of the other aspects I like to do is not assume that I'm going to hold it for all 10 years. We're actually just taking like a median of all 10 years. I have the IRR if you hold it at 1 year. I have the IRR if you hold it at 2 years, 3 years, 4 years, all the way up to 10 years. And I just take the median between that, so that it's like, who knows? Maybe I only hold it for 2 years, 3 years, 5 years. I don't know. But on a median basis, on an earnings basis, you would expect kind of mid-teens percentage returns for FG. And then also, like I said, the cash flow based valuation, I get about a mid-teens base expected return as well, and also 60% plus upside to the current price based off of that. So that's what I get. Fair value around 38, 38, high 30s, 40, something around that kind of base price is what you would want. I would argue that there's lots of levels of conservatism baked into this, depending on what you could think about this from multiple levels. But yeah, so I'm pretty pleased with that. I think, like I said, by doing all three statements together, it really helps me understand like where the cash is in relation to the earnings, and also in understanding like the deposits versus the withdrawals versus the investments coming due versus the index credits, and like trying to understand the dynamics of all that. That really helps me feel much more comfortable about what's happening with FG, because it's really easy to hear all these concerns and to assume that, oh my gosh, it's going to be like a huge rush for the exit or something because of the private credit scare. And it's like, as I said before, like the actual funds in which they are locked up in with private credit, I think are pretty well locked up. And it's insurance companies that are not rushing for the exits. So I think the asset side of their situation is pretty well managed, and the liability side of their situation is pretty well managed, because as I was saying with the cash flow statement, they could actually have pretty significant amounts of outflows if people wanted to just surrender the account value and take their money back. Even though yes, they get surrender charges when that happens, it still creates cash flow crunch if a huge amount of their customers decide that yes, they want to just take the charge and get out. But the point is that they have a huge amount of cash flow coming in just on a gross basis regularly all the time. Whether it's, as I said before, they get at about 35% of whatever their gross sales is, they have coming in on an operating cash flow basis. So if their current gross sales in the last year was like 14 billion, was it 14.6 billion or so was what we had here. So you can see like 14.6 billion times 35%, that, oh, whoops, I need to multiply that by 10. Gets you 5.1 billion or so of cash flow from operations that we would expect on any kind of typical year basis or something like that, right? But then also, as I said before, you also have assets coming due each year, just like a certain amount of cash flow coming in from the investing cash flows, which has been about 70% of your assets less cash relative to the duration. My bad. And the current duration as it's currently set would be about 21.5 billion in 2026. So that means about 70% of 21.5 billion. So like this plus about 70% times 21.5 billion. That's about 15 billion. So add those together, that's about 20.1.2 billion. So that's about $20.1 billion in cash coming in the door at FG every single year, if you include both just their assets coming due as well as new sales that they've gotten, if you at least take the sales that they had last year as a given, right? 20.1 or 20.2 billion dollars in stuff coming due. And then, like as I said before, come over to FG, that commitments page here in 2026, they're expecting 10.3 billion in these commitments that they absolutely have to put out the door. And then technically, so we can subtract that out. We can subtract out 10, 2, 5, 8. Oh, my bad. I did 20. That means they have 9.9 billion left over. And keeping in mind that cash flow from operations included the index crediting already, so that's already really been handled technically, 9.9 billion. So there's that. And then the deposits, the financing deposits have already been handled due to the sales technically. So at that point, it's just a question of how many withdrawals you have. How many withdrawals you have at that point. And if I come back over to that, we could take a look at the withdrawals relative to debt liabilities. It's about 55%, and the modeled amount that we would expect to be here would be 17.5, so we would expect a point 11.2. And technically, actually, I realized I forgot, because that doesn't actually include the deposits. I was actually sort of assuming the deposits was already baked in there, but no, it's not already, and that would be 95% of it too. So the point being is that even on a net basis, 2026, I would expect there to be like 5 to $6 billion in net excess cash flow coming through the door. Not free cash flow, like I said, like we don't want to call that free cash flow, but cash flow that doesn't really have a claim on it. Cash flow that there's really nothing to do with other than to just buy assets. That's basically my point. So it's basically just like $5 to $6 billion expected to come in the door in 2026 for FG, that really there's nothing for them to do other than to just buy more assets and sit on them, right? So yeah, that's why I'm not worried about this valuation. Like, now that I've put all these pieces together, it gives me the ability to put this valuation in there, and not just to have it based off of this kind of like ephemeral gap earnings number. I have an ephemeral gap earnings number, but I also have like a cash flow number that I think makes sense, and makes sense with their balance sheet as well. So yeah, very satisfied with this valuation. Not satisfied with the stock, obviously, because obviously the stock has been like a total piece of shit to us for a long time here. But as I was saying before, Mr. Blunt is still out there making purchases of the stock, and the FG has now made their own repurchase commitment, or not commitment, but authorization here. And as I said before, I think that there's signs to show that their board of directors has been reasonably good about that capital allocation decision in the past. So I think there's good reason to believe that they will maybe use that commitment as quickly as they can. And maybe if we're lucky, they will make more commitments in the future. I don't know, hope so. But also the other thing is that this analysis should show is that they have the cash to do that too. That works out. It's not just like theoretically they have an authorization, but the cash itself is doable. I do have the estimate here. As I said before, I have my buybacks weighted towards the back end here, but I do have that estimate here based off of the prices based off of those trailing multiples that I said here. That's why I have the estimate for each year. Is I want to be able to price at what price I'm doing the buybacks at, and so here I have like here's the dividend cash. The dividend cash is already 130 million per year, and I have it scaling to about 140, 150 million per year by the end of the 10-year period. So it's like on average 145 million per year. But buybacks on average I have being about 126 million per year over this 10-year period. So I basically have buybacks equal to dividend levels, roughly speaking, in here. And again, that's already kind of accounted for relative to the cash balance. So long way to say that, yeah, they have the authorization. They should theoretically have the cash to do it, and they absolutely have a price discount. Another thing I would kind of point out in terms of like price discount, like obviously we have our theoretical ways of valuing the company, but Mr. Blunt, our CEO, whenever talking about the valuation of the company, he has only ever referred to price to book. Price to book is the only metric he has ever referred to when talking about the valuation of the company. So I do want to point that out as well. The price to book when they made that previous authorization was like 0.76, whereas we are currently 0.67. We are a lower valuation by book than we were then too. So yeah, and also by the way, my it's worth noting that I did do the math, but my fair value I have here equates to about a price to book of 1.1. I think it was like 1.13 or something like that. So I actually, my fair value for the stock is essentially less than the average price to book that they traded over this entire time frame, keeping in mind that they did have a little bit of a period here where they were trading at 2 times book. So admittedly, that was probably a pretty rich valuation there. But sure. Even if I just kind of skipped past when they corrected from that bump there, then my valuation is still below that average, you could say too. So just another way to kind of think about the value of them. So anyway, we went for 2 hours and 40 minutes. I was definitely hoping to try to keep it more like 2 hours. So we definitely went longer than I hoped. Like I said, I kind of went longer on inflation than I had hoped, and I definitely rambled at parts of the FG story more than I'd hoped to as well. But we did end up sort of covering basically everything I wanted to cover with FG for the most part. So that is good. It means that we sort of got the job done there. No one really came to show up in the chat today. I saw some viewers in and out of the viewer count, so it seems like we at least had some lurkers watching, so I appreciate that. I did forget to say at the start, as I often do, which sucks because it means you have to kind of wait to the end to hear it, but please like the stream if you're with me up to this point. If you enjoyed the content up to this point, please subscribe if you haven't already, hit the notification bell, join our free Discord. Link is in the description below. It's also the pinned comment in the chat there. Feel free to send me PayPals or Patreons or any of the above type of donations that you would like. I would love that kind of thing as well. If you think the content merits that kind of gift, it would be appreciated. But otherwise, I will catch you all in a couple weeks when we will probably talk about, on the economic front, we'll probably talk about growth. But as far as stocks, we'll see what we talk about on that front. I will give like one kind of little detail. I have been doing lots of updates to valuations over the last like couple weeks in various ways. So there is, and also adding companies to the list as well. So I have been looking at other companies. I've been looking at some of the royalty companies, the gold royalty companies. I've been kind of like interested in some of those ones a little bit. Corn Ferry is one that I think maybe looks kind of interesting. Been looking at Adobe more and more and more. I know I've already been talking about that one a bit here and there. Uber, I do think also continues to look interesting. Dassault Systems looks kind of interesting. Obviously I talked about BP somewhat in the past, and that's been going well. But yeah. So I have been doing some valuation work. I haven't just been working FG stuff behind the scenes. So maybe our next show we'll be talking a little bit more about a wider spread of companies. But I would appreciate recommendations in the comments or in the Discord of companies to look at, as I always do. So that would be stuff to maybe talk about next time. Jonathan, I see you. Yeah, made it in last minute. Appreciate it. But I'm sure you will appreciate the full stream to go back through and listen to, since it's a very, very detailed stuff related to FG and like how to think about their financials and private credit and stuff like that. So I'm sure you'll appreciate all that. But all right, appreciate you all. Catch you all next time.